key story is tech boom. And that's going to be the most important.
The market can still go up.
I can't just tell you to sit here and hold your nose and sell.
The question mark around potential bubble euphoria does continue to build up.
We have to be wary that it's not going to last forever.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, NASDAQ futures slide. High-flying tech stocks in South Korea plunging more than 10%, following an ugly three-day market rout for newly minted SpaceX, heading into quarterly earnings from Micron due out later this week. Those numbers just a day away.
And there clearly is a lot of nervousness given the fact that Micron is up 880% over the past 12 months. And there's nervousness more broadly throughout the entire tech sphere just because there is a hope and a prayer that the demand for the most expensive AI products will continue, which has been part of what's fueled the semiconductor bet. Now there's some pushback you're getting from certain clients. Can that continue with the same profitability from the semiconductors? That seems to be some anxiety.
We've talked about this massive wealth transfer from the hyperscalers to the chip players. Look at the pushback you're seeing to the big spenders right now. Microsoft, Meta in bear market. Amazon, Alphabet down double digits in just a month or two. Some big pushback emerging.
And Dan Curtis from the Bloomberg television team put out a great chart talking about how the hyperscaler stocks have directly correlated with the amount charged for each token that companies are spending to try to use large language models. You've seen places like Uber push back on the cost of what these tokens are really amounting to. So if people are starting to look at the practical uses, how much are they going to push back at some of the most expensive aspects that have fueled and packed the coffers of these hyperscalers?
I briefly spoke to Dan Ives this morning, who's talking about he thinks all of this bubble concern is stemming in South Korea because SK Hynix overtook Samsung. He says a lot of cultural issues with this, and it's a little bit of a psychological issue. He said it's like basically the Yankees doing better than the Mets in October. And that is why there's all these fresh bubble concerns in the market right now, even though he doesn't agree with it and pushes back.
It's 602. It's not even 602.
Just
really?
taking jabs, taking.
I'm quoting Dan Ives.
That is totally kosher. Okay, whatever.
Take it up with Dan.
Yeah, take it up with Dan. Yeah, right. That's right.
Jeez, you two already. 2 minutes into the program, fighting over sports.
I mean, she went there. This
what are we
is
doing baseball for?
I mean,
I'm quoting Dan Ives, and I think it puts into perspective what's going on in South Korea.
Deep breaths, everybody. Live TV. Okay. We good? We're good. Futures negative. We're down by 2.5% on the NASDAQ. On the S&P 500, down by 1.2. Check out dollar yen. We're talking about a 10% move over the last 12 months. On a currency pair, that's a big move. We're talking about a 40% plus move over the last 5 years. 161 on dollar yen. And the prospect of intervention.
Yeah, with a discussion with the Foreign Minister and Treasury Secretary Scott Bessent overnight, this is potentially reaching the weakest level for the yen going back 40 years. What kind of intervention could they engage with? And frankly, what would it do? I think that they blew some $72 billion earlier this year trying to intervene with the yen. And that was evaporated within a couple of days. So at a certain point, what can they do other than just to hike rates more significantly?
One thing is that they said that this meeting was a follow-on on the G7, maybe to temper some concerns, but at the same time said that they would be willing to, quote, take bold steps on currencies if needed, and that they align on foreign exchange policy. So that obviously gives a little bit more of risk momentum that potentially they could intervene.
Dollar yen coming in about 0.1% so far this morning. Let's get to some good news as well. Crude, Brent and WTI comfortably in the 70s now. WTI at the moment about 73, Brent crude around 77, yet still the rate hike debate getting extra fuel from several Fed speakers, including Goolsbee, in just the last 24 hours.
Yeah, coming out and saying, look, this is a real problem. They haven't hit their inflation goal. And really leading into this idea of forward guidance not necessarily being the panacea, seeming to support the new Fed chair, Kevin Warsh, as he talked about how inflation is, quote, going the wrong way. If you get all of the Fed members lining up behind Kevin Warsh, not only with respect to a hawkish tilt, but also with respect to a lack of communication or forward guidance, that will be pretty powerful.
When it comes to oil, we are seeing prices continue to slump because not only is the Strait of Hormuz open, yesterday the U.S. Treasury, we haven't seen this in decades, is allowing Iranian crude to hit the oil market. Even U.S. refiners, likely won't happen, but U.S. refiners could buy Iranian oil, something we have not seen since 1991.
Brent crude 77 this morning, yields lower across the curve as well. Two's down 4 your 2-year at 418. Coming up this hour, we'll catch up with Julian and Emanuel of Evercore as tech stocks slump. We'll speak to Jayati Bharadwaj of TD Securities with the yen hovering near a 40-year low. And Pierre Ferragu of New Street Research as SpaceX shed $600 billion in value in just 3 sessions. We begin this hour with stocks sliding as the tech sell-off deepens. Julian and Emanuel of Evercore remains constructive, writing, "We remain steadfastly bullish, led by AI names and themes. Stocks remain on course for 77.50, and the 9K bull case is still operational." Julian joins us now for more. Julian, good morning.
Good morning.
Sounds somewhat contrarian after the few days we've had.
Well, first I want to say is, given the sports intro, we should start talking about Messi again, which we were doing prior to the top of the hour.
We're going to make some time for that a little bit later, I think.
Fine. So I liken this to the beginning of the year when you started to have the accumulated worries around software and the initial concerns around debt, which obviously the debt pile has gotten much larger, which earnings are supporting. And you got this intense negativity around technology stocks. And we felt like we were contrarians coming into the beginning of 2026, sticking with the call. And frankly, we saw the progression into the most hedged position we had ever seen in 30 years at the lows in March. And the market isn't hedged to that degree, to be sure, but the skepticism is there. And frankly, when you think about it, you're just sort of transitioning this wall of worry away from the malign effects of high oil and into the potential concerns around supply and less transparent monetary policy.
So you say the bull case is operational, yet we started the program by pointing out a couple of names. The likes of Microsoft and Meta deep into bear markets now. Can you have 9K on the S&P, operational, so to speak, without those names participating in any way, shape or form?
Mathematically, you can't, okay? And when you look at it, the chip names, have done a great deal of the heavy lifting. You will need a refreshed attitude towards the Mag 7. And we think that comes in time. And if you look at it, over the course of this bull market, now almost 3 years old, there have been certain periods of time where essentially earnings and price have, caught up to each other. And we think that's one of these periods in these larger names, and that you will have price start to advance once more.
What will it take for people to have a refreshed attitude about the hyperscalers?
It will likely be a little bit more churn, a little bit more volatility, a little bit more negativity. And then ultimately, the proof of the pudding, that was the proof of the pudding that caused this furious rally to begin with in April and May, earnings. You're going to see good earnings.
Are we starting to see the beginnings of pushback from the adults in the room, the bond investors, saying, hold on a second? And we're talking about this particularly with SpaceX, not necessarily leading off the entire sell-off, but not helping exactly. This company that just IPO'd, coming back to market for $20 billion. It's investment grade, even though it's been burning cash and it has, a prospect of getting to the moon, literally, and beyond. How much is this the beginning of something that's important to watch?
Well, again, this is the point where we will figure out how supply and demand interact, because clearly the message is, well, you IPO'd and maybe you should have waited at least till you got included in the NASDAQ 100 before marketing debt, but here we are. And to us, again, when you look at the market action, it's just a much more significant volatile churn. And again, with that name in particular, you're still comfortably above the IPO price. So, I mean, they may send people to the moon and to Mars, but stocks don't go to the moon and Mars indefinitely.
For now, at least, we're down another 4% in the pre-market. Headline, hardly talked about, small caps, record highs. What's going on there? The small caps move, which is where the outperformance has been so far year to date.
So, during the course of the entirety of this bull market, small caps have been the default short for active managers. And that really kind of faded as the year started. Again, partly as a function of the concern around technology that started the year, but more presciently about this fact that we may be having agitation about where the short end of the interest rate curve is going to go. But guess what? The long end is incredibly well anchored around 450. And oh, by the way, the labor market it's adjusting. And all of those are positives for small caps, as is the price of oil. And then last point here is that, again, this tends to be around the Russell rebalance, the time where you get your maximum small cap outperformance. We wouldn't be surprised by a little bit of reversion as the third quarter starts.
I understand small caps will like the depression we're seeing in the oil prices, a bit softer. But what about the fact that the Fed is raising interest rates?
Well, again, I think, and this has been a lot of our conversations, is that there tends to be this glass half empty view of where the Fed is going, okay? But if you think about the one thing that Warsh did that in our mind is a very distinct positive is he absolutely established the concept of Fed independence, okay? We've been worried about that essentially since 2018. We are no longer worried about that. And this is a contrarian point of view. But that 9-9 vote, in a lot of ways, does Warsh a favor. If he needs to raise rates, he's got the cover to raise rates.
I think there's also some good news with regards to the potential for rate hikes. The fact we're not talking about labour market weakness anymore. The way that a lot of people on Wall Street are framing the potential for hikes right now is taking back the insurance that was taken out last year and the year before because of the weakness that emerged in the labour market. It's the firming up of the labour market that's allowed them to focus on the inflation side of the mandate. Now, I know that for markets that might not be good, whatever, but for the economy, the signal you're getting from the economy is a green light to address the inflation situation because you don't have to worry about the labour market in quite the same way. I've got to say that's kind of good news.
That's the reason why you're not seeing stocks sell off in response to this. That's the reason why you're seeing some of these small caps outperform. I will add, though, what Julian is talking about here is fascinating, which is by potentially hiking rates, they're easing the policy rate on the long end, which is essentially what you've seen. They've anchored the long end of the yield curve, which has actually helped ease financial conditions for a number of companies.
If you're looking to borrow to buy a house, for instance.
Correct, which is exactly what people point to as a potential weakness in our economy.
Futures right now, erasing some of the losses this morning. We're down by about 1.2% on the S&P. Julian Emanuel of Evercore will stick with us. We'll get some World Cup commentary from him in just a moment as well. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, good morning, John. Iran is trying to sell oil to Asia's largest buyers as the U.S. sanctions waiver takes effect. Tehran is eager to find a wider range of buyers and to clear oil currently in tankers, with at least 80% of the volume on the water not having a clear destination. SpaceX shares declined for a third straight day, falling to its lowest level since the company's first day of trading, and erasing more than $600 billion in value over the same time. Shares now on track for a fourth day of declines, dipping below SpaceX's first day's opening price of $150. In sports, Lionel Messi is now the all-time leading goal scorer in World Cup history. After missing a penalty shot against Austria, Messi scored twice to power Argentina to a 2-0 victory. He now has 5 goals in 2 games so far in the tournament and has 18 all-time in his World Cup career. And that is your Bloomberg Brief, John.
Vonnie, thank you for the update. 39 years old tomorrow, playing elite football. It's just amazing to watch, Julian. I was getting goosebumps watching this guy yesterday. Score those 2 goals, just absolutely phenomenal. Still hungry. That team is an absolute unit, a unit full of assassins.
No question. I mean, greatness is something to behold.
Don't you feel
it really is. Totally.
You really do feel like you're watching that, experiencing that at the moment.
I mean, honestly, you know, when I was 39, I could do that. But now...
I was watching that yesterday thinking early 40s, not too much older than him.
Oh, my gosh.
How's he still doing this?
Yeah, I mean, honestly, he is absolutely a beast. Maybe it's just, you know, something in the water.
Let's see what Ronaldo's got a little bit later. Up next on the programme, leading in quantum.
Quantum technologies represents the next generation of innovation across computing, sensing, and networking. We're already the leader by a lot, and we're going to be now the leader by a lot more.
Up next, we'll catch up with Bloomberg's Tyler Kendall down in Washington, D.C. Live from New York City this morning. Good morning. Kospi down 10% at the close. Equity futures this morning negative by 1.3% on the S&P 500. On the Nasdaq, down by 2.55. On the Russell, coming off record highs, down by 1.5% so far this morning. Into the bond market, crude lower, yields lower too. Two's out to 30s, two's down by 4 at 418. Goolsby of Chicago sounding somewhat hawkish in the Fed speak we got in the last 24 hours. Governor Waller not offering anything. President Williams, the next one to watch coming out of New York.
Yeah, I was looking at Governor Waller's speech and I'm thinking, like, really, none of us care what you think about the dollar and the role of the dollar over the next 20 years. I mean, we care.
Chris,
sure,
if you're watching
but,
this morning, I care.
Chris, I mean,
great speech. Fantastic. Carry on, please.
All right, I'll leave that there. But meanwhile, Goolsby actually did come out and started talking about how inflation has been well above target, has been going in the wrong direction. And also, again, was sympathetic to this view that maybe people speak too much and forward guidance can sometimes be more of a problem than it is actually helpful.
I know Governor Waller tunes in around now, so good morning. Some of us enjoyed the speech.
I think it's great. I just think that that's not what we were looking for, just because we all want to hear what you have to say about inflation. So, Chris, please come join us.
Noted, he's scheduling the speech right now. And the appearance. Crude, as I mentioned, we're down by 0.5, 77 on Brent. Talks go on and on and on. The barrels are moving. That's what people are focused on. We've got some waivers. Iranian crude, they're going to be moving Iranian barrels. Are US refiners going to buy Iranian barrels?
Don't know yet, but legally it looks like they are going to be allowed to
consider
in terms of this license until the end of August when the 60-day period is up for. Yeah, it actually is wild to think that U.S. refiners could actually start purchasing Iranian crude. Do I think that's really going to happen? Probably not. It might extend their customer base outside of China to other countries in Asia, but they have a waiver now to pretty much sell to anyone. Other issues might come up, like EU has sanctions on Iran, so maybe the European Union is going to be a problem for them, but right now, not OFAC.
WTI this morning down by a third. We're at 73. Let's focus on Washington, D.C. Under surveillance this morning, leading in quantum.
Quantum technologies represents the next generation of innovation across computing, sensing, and networking with enormous significance for our country's economic growth. We want to keep that positive momentum going. In America, we're already the leader by a lot, and we're going to be now the leader by a lot more.
So here's the latest this morning. The president signing executive orders to boost U.S. dominance in quantum computing. The administration announcing major equity stakes in 9 quantum computing companies just last month. Bloomberg's Tyler Kendall has the latest. Good morning, Tyler.
Hey, John, good morning. Well, that announcement last month came alongside $2 billion worth of funding and means that the U.S. government now has equity stakes in more than 20 private companies, which the Trump administration says is all about bolstering U.S. national security. But at the time of the announcement, the U.S. Commerce Department told the Wall Street Journal that it was, quote, spreading out its bets among these 9 quantum computing companies and acknowledged that it could take some time to pan out because analysts tell Bloomberg News the industry has made some pretty major breakthroughs recently, but is still working to overcome some pretty large challenges to actually use the technology at scale. The simplified idea here is that quantum computers, which are capable of solving problems much faster than traditional ones, complement the advances that we're seeing in artificial intelligence, which is part of why the president put out these executive orders yesterday, one of which would seek to have the federal government work alongside private sector companies to build a supercomputer that can do scientific research by 2028. And the second executive order was geared towards bolstering against cybersecurity risks. John, we saw some pretty significant investment, of course, from the private sector, and executives yesterday from IBM and Alphabet joined the president for the signing. You also, of course, heard President Trump talk about the idea that this is all going to be incredibly instrumental in helping the U.S. compete when it comes to China.
Tyler Kendall with the latest in Washington. Tyler, thank you. IBM in the pre-market up by 4%. Julian Emanuel still with us. Julian, we have a new whale in the tech sector, and it's the U.S. government. How are you thinking about that?
Well, look, again, there's the concept of picking stocks and getting national champions, and you've seen it with a number of names, very old line U.S. technology names. In the bigger picture, anointing winners and losers has its own issues in terms of the government level. But frankly, the fact that the government is as, forcefully behind the AI revolution as it is is a positive in our mind for investors broadly.
Well, we see this administration do it with Intel and a number of rare earth mineral companies. Do you just have a list of potentially the next company the U.S. government might take a stake in, and then the stock is off to the moon?
We did that a number of months ago. I would say it was very well received and certainly worked. But again, I think we're far enough along. And again, this is also part of the investment problem in general, that when you look at the major sectors, it's now 58% of the S&P 500, the top 10 stocks, 40% of the S&P 500, that there is a little bit of psychological crowding out in trying to find companies with smaller market caps.
But the heavy hand of the U.S. government, does it distort the market?
Classical economics would tell you that it does, okay? But again, I go back to this idea that the bigger picture in terms of making sure that the U.S. is front foot versus the rest of its global competitors in technology is a positive.
There's also a sense that there's a rolling ball of money that is racing to the next corner, the next big thing that could potentially take off as this build out in tech continues, and that people aren't sure what the ultimate goal is, what the ultimate form of AI is going to take in terms of the way it's displayed throughout economies. At the same time, it's just racing to get there, whether we see it in SK Hynix and Samsung or whether we see it in the semiconductors in the United States. How does that destabilize markets? I mean, how much is that something that you're watching?
Well, it just shows you that volatility works both to the upside and the downside. And actually, for us, is very interesting. And the reason we don't think we're in a bubble right now is because for the last 6 weeks, clients have been asking, how do we hedge AI? How do we deal with the fact that the AI trade is everything? It now dominates emerging markets. It's changed the relationship of gold as a hedge. It's changed the relationship of bonds as a hedge versus stocks. And our answer is actually this is a very interesting time. On a day-to-day basis, there's a larger universe of stocks in the S&P 500 that are moving inversely to the S&P day in and day out. We call them negative beta names. That really act as a portfolio diversifier. People are looking for reasons to hedge, yet stay invested.
Are stocks the best hedge to stocks versus bonds being a good hedge to stocks in this environment?
Well, in an environment where we're concerned about higher inflation broadly on a sustained basis, history tells you that stocks are the best hedge.
Can you describe those stocks? Where do we find those stocks?
They are across, an entirety of industries. Energy, obviously, in the narrative of this entire year has basically been energy moving inversely to the S&P 500. But you also see it in consumer names. You see it in utilities. And of all the strange places, you actually see it in select financials. In our mind, that is definitely different behavior.
Yeah, what do you make of that, the banks trade? Because they were meant to be the big beneficiaries of all of this technology.
I think, again, what it is sort of a preference. I remember years ago at a different shop, our oil analyst said to me, in the midst of a massive rally in oil, when are my stocks going to start rallying? And I said, they're going to start rallying when they start selling technology. Okay, and so when I think of financials, that's likely going to be the outcome when we take some chip. If you look at yesterday, financials traded very well in a negative tech tape, and that's kind of the narrative.
Julian, good to see you, as always. Thanks for dropping by. On tech, on a World Cup, Julian Emanuel of Evercore, with equity futures down about 1.2% this morning on the S&P 500.
Yeah,
a key question is going to be Micron, right, coming out tomorrow, and can they continue to deliver with their plans for the most expensive chips? Are those hopes and dreams of powering the race to space and beyond?
You don't sound convinced, Bramo, I have to say.
I mean, 880%. You know, it's pretty good for now.
Coming up on the program, we'll catch up with Bharadwaj of TD Securities as the yen nears a 40-year low. Equities declining this morning. We're down by 1.3% on the S&P. On the Nasdaq, tech stocks under pressure. We're down by 2.7%, declining to start the week following 2 weeks of gains on the S&P 500. Within the S&P, notable loser in the last 24 hours, Alphabet under pressure. Some key talent departing for the likes of Anthropic. We can touch on that story a little bit later. Outside of the index, SpaceX not exactly helping the tone around tech stocks yesterday or this morning, for that matter. In the bond market, check out the front end of the yield curve. Twos at the highest level in more than a year. At the close as of yesterday, this morning we're down by 4 basis points. 418 on a 2-year. As we get more and more Fed speak, supporting the idea that maybe we're moving towards rate hikes of this Federal Reserve.
Yeah, Chicago Fed President Austin Goolsbee coming out yesterday saying that inflation's moving in the wrong direction. We see now a 98% chance of a Fed rate hike by September. That is before the midterm elections, most notably. So interesting kind of timing. And we saw the 10-year real yield reach the highest level in a year yesterday. So you look at all of these confluence of events, and you start wondering, is this going to draw people back to the bond market this morning? Yes, it is.
It's kind of interesting, isn't it? We've talked about this a few times over the last month. How dependent or independent is this Fed call on what happens with crude? And yet we've gone from triple digits on crude down into the 70s, and still rate hike bets are firming, they're not fading. And that tells you this is more than just about energy.
There are two aspects here. On one hand, there are lag effects from the energy experience and the idea that some of the deliveries haven't come for a while, and people are expecting that to continue. But inflationary inputs have been increasing from a whole host of different areas, in particular from those expensive semiconductors that SK Hynix is maybe pulling back on. So some of these inflationary pushes have come from far beyond the oil trade, and that's what's getting people nervous.
Brent is 77.64 this morning. Let's finish on the FX trade. The currency pair of the moment, dollar-yen. Big move in the last 12 months, major move in the last 5 years. Dollar-yen this morning, 161, very close to 40-year lows for the Japanese yen, and very close apparently to intervention from the Japanese, and maybe in coordination with the U.S.
And this comes after a phone call that you had the Japanese finance minister have with the Treasury Secretary, a follow-on of a conversation they had recently at the G7 when it comes to that meeting in France. And this is what the quote. The finance minister said that they agreed to take, quote, bold steps on currencies if needed, and said the nations are increasingly, quote, aligned on FX policies. So now everyone is on high alert that potentially you could see this coordination and some sort of intervention. Or right now, is it just strictly rhetoric to try to have the jawboning do the work?
Just a little bit of yen strength in the FX market this morning. That's the cross-asset price action, 3 hours away from the cash open. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. The tech sell-off is hitting some of this year's biggest winners the hardest. The chip and memory names like Micron, SanDisk, and Intel all falling sharply in the pre-market, and it mirrors what we saw in South Korea, where memory names led the 10% sell-off on the Kospi, particularly SK Hynix. There was this report out there saying that it may slow its AI memory business, shifting to DRAM, and that is sparking fresh concerns about demand just in time for Micron earnings tomorrow, so dramatically raising the stakes for that name, which is down 9% in the pre-market. Meanwhile, the tech sell-off is also hitting the newest entrant to the public market. SpaceX shares are falling 4.25%, on track for a fourth straight session of losses. Yesterday alone wiped out $400 billion in market value, the second biggest one-day loss in stock market history. And if we maintain these levels, SpaceX will open with a market value of below $2 trillion. But I managed to find one bright spot in tech, and that is IBM. Shares are up 3.25%, and it's really on three positive developments. First off, it announced a cybersecurity partnership with OpenAI. It picked up an upgrade by analysts over at JPMorgan. And as Tyler mentioned earlier, its CEO received high praise from President Trump at a White House quantum event yesterday. John?
Stock up 3% in the pre-market. Yahara, thank you. More from Yahara in the next hour. On our radar this morning, the US granted Iran a 60-day license to sell its oil on the global market as peace talks press on. The measure marking the most sweeping rollback of Iranian sanctions in decades, unlocking billions in potential revenue for Tehran. Elsewhere, Apollo imposing another cap on withdrawals from its private credit fund for retail investors, limiting redemptions to 5% of outstanding shares after investors aim to pull nearly 17%. And finally, SoftBank founder Masayoshi Son saying there's little merit to the idea of building data centers in space, dismissing one of the key ambitions for Elon Musk and SpaceX. Some pointing to the high cost of the concept, saying the AI race will be won on the ground.
He who strikes first wins. These are some of the incredible wisdoms that we heard from Masayoshi Son as he talked about this, talking about Elon Musk as an incredible investor, but saying ultimately you have to focus on what's going to happen in the next few years, not the next few decades, and that the AI race will be won in the near term, not the medium and longer term, which is clearly the ambition of SpaceX. SoftBank hasn't always been right, although they have been a huge backer of a lot of the technological prowess that we have seen. Really interesting to see this cohere with the fall below $2 trillion for SpaceX.
Shocking.
Oh, my goodness. How will we survive, and whether that will continue its descent or whether people will continue to rally around this name?
It's not Elon Musk. It's also Jeff Bezos, who feels that they can build these data centers in space. It's a place that you can get cheaper compute. You can rely on solar power to do all this, then it beams back to us here on Earth. In the past, he's put it 10, 20 years. I know recently he said the timeline very unsure of, but it's not just Elon Musk who thinks this. I actually once caught up with Jeff Bezos' brother, who told me it was either high school or college. He literally wrote a paper about how he wanted to start Amazon, to build a company so that then he was able to have all this money and knowledge to then put data centers in space. Something these people have been thinking about for decades. It didn't just all of a sudden happen in 2026 when everyone's obsessed with compute.
The real passion project. Yeah. For these big tech players.
I did that in high school, too. Who didn't write some paper?
I was very focused on football.
Yeah, I don't think so. Yeah, I don't think that was...
Space.
I mean, I actually admire the people who have these passionate visions since very little.
The thing is, they actually do really think it's realistic. I know it sounds out there, but they truly believe it's realistic, and they are working on that every single day. And it's part of the reason why Blue Origin decided not to do commercial flights anymore.
Look, when it comes to Elon Musk, we've been proven wrong time and time again. The focus today, that $20 billion debt offering, should get some details of that a little bit later.
Yeah, some pushback, because on one hand, you can talk about the hopes and dreams being baked into the stock price. You're potentially compensated for that because you've got the upside as well as the potential downside. With bond investors, they just want their money back. And so if you're looking at someone who is hoovering up as much cash as they can and borrowing a lot to do it, you have to start wondering, how about that payment back a certain time later? And what do I get to be compensated for that?
Pretty vanilla and very boring, isn't
it? Well, I mean, I kind of like that.
You don't get the upside in the same way, to your point.
Yeah, but you want your money back, so it's about counting beans.
Without a doubt. Look out for those headlines, potentially a little bit later on. Let's talk about foreign exchange. The yen nearing its weakest level in almost 4 decades. Intervention risks are rising as US Treasury Secretary Scott Bessent and the Japanese finance minister agreed to take, quote, bold steps on currencies if needed. Joining us now is Jayati Bharadwaj of TD Securities. Jayati, welcome to the programme. Good morning. What do bold steps look like? Can you describe for us what you might be expecting?
Thank you so much for having me. Unfortunately, Japan is running out of options. Already, this has been a very tumultuous year. They've tried everything. They've had Bessent do the soft rate check in January. They've tried aggressive verbal intervention. They've tried a real intervention. They've tried a hike. None of that has worked. I think credibly, it's all about interest rate differentials, which is where Japan, even if they hiked, did not signal credible future hikes or any sign that they are now on a path to hiking interest rates more credibly. Whereas now you had a very hawkish Fed last week, which sort of threw them in the spanner because now US interest rates have clearly risen, which has always been the pain point for yen. Now, I think their main concern is hopefully that the conversation that leaked out, and I always say leaked with air quotes, is that it does the jawboning for them and establishes now maybe 162 as the next 160. But short of a coordinated intervention, the only durable way to relieve pressure off of yen is either Japan gives up its very cautious bias, or to their benefit, for some reason, US data starts surprising to the downside so that the hawkish pricing for the Fed comes down a little bit. Short of that, it's only coordinated intervention, which historically was done during the 2011 earthquake. Yep. But these are not those times. And I'm not sure the US wants to send a signal globally. We are willing to sell dollars outright to help out one nation with the currency when there's no active, natural disaster or liquidity crisis.
You went there. There are always policy trade-offs. And Japan has decided that they don't want to go on an ambitious rate hiking cycle for other reasons. Why is that our problem and not just theirs?
So I think a little bit of it has been political, which is why a lot of people did start getting into the short yen trade, especially around elections, which is where Bessent, helping out Japan as a very strong ally, said that let me help you out here and let me do the soft rate check on your behalf. So I think the similar thing we saw with Bessent in Argentina last year it seems like the Treasury market and, the head there is showing a little bit of a more activist approach to this. And he's definitely a lot more geopolitical than previous Treasury secretaries have been. So I think it just signals to me that Japan is the largest holder of US Treasuries at this moment. We've all heard of the debasement trades, Asian central banks wanting to move away from Treasuries. China, we know, has been selling for, a long number of years. Japan is now the largest holder of Treasuries. So that also, helps you understand that backdoor relationship quite a bit.
Why wouldn't the Bank of Japan just hike rates more significantly? Because part of the reason why you saw the sell-off persist was because they were somewhat dovish in their rhetoric relative to market expectations.
So there were a couple of things. So first, unfortunately, Ueda, who is more hawkish on the board, was hospitalized. So the second in charge did the press conference, who is a dove, so he sounded more dovish. Secondly, Japan, you could say for conservative reasons and also political reasons under Takaichi, who has not always been a strong advocate of the Bank of Japan hiking interest rates. In fact, she comes from the understanding that you should keep policy interest rates low to keep fueling the economy, and that should fuel inflation. So she comes from the opposite mindset. She's not looking at it from the fact that bond investors are now demanding Japan to hike. Inflation is running, rampant. You have enough credibility now that wages have been moving in the right direction for the last couple of years. Growth is on a better trajectory. But it's some political reasoning there why BOJ is also not moving so aggressively. And ultimately, she did stack the board with doves rather than hawks.
I wonder how much the strength in the dollar and the newly hawkish turn of the Federal Reserve is going to pressure currencies around the world in a way that people are not expecting. This was more of a shift than people thought. You are seeing some significant dollar strengthening. How disruptive is this going to be globally?
I think that's a very active debate that Warsh has set up recently in markets. Is that what he's talking about is clearly a move towards a shift in the bias of the Fed towards hiking. And you can see that from the dot plot as well, and also from the innumerable number of times he mentioned price stability this time around. But I think the question is that coming from the fact that the Fed members as a whole, as a board, thinks that neutral rate in the US is higher, which means that the debate that we've been having with the US is that US policy rates are in restrictive territory. If they think R-star is higher, then that's not true. Then rates have not really been in restrictive territory. So then that actually raises the long-term R-star projection and the long-term interest rate path for the Fed, where you could be like the 375 is actually not restrictive. It's at neutral, basically. The second debate is that, so right now there's so much confusion in markets because Warsh has been very, very still guarded with his opinions, which is why markets are now pricing close to 2 hikes, followed by some easing next year, which is also very unique. So there's some mismatch there where markets think that he's talking about hikes, but it's more short-term solution to the inflation risks from, the Strait of Hormuz. But markets are still expecting interest rates next year to then come off after the bump higher in interest rates. So I think the move lower interest rates next year is the one which, if that's challenged, if Warsh in future meetings signals that no, at 375 we're not restrictive, or potentially he says we're somehow stimulative because of AI, CapEx, I think that will shake markets. That will be a big move, not just in hike pricing this year, but next year, and that will induce a lot of volatility in global asset prices.
Jyoti, it's good to see you. As always, could be quite a summer. Jyoti Bharadwaj there of TD Securities with the 2-year very close to the highs of the year. Yields down across the curve so far this morning. With an update on stories worldwide this morning with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Andy Burnham under pressure to outline an economic plan for the United Kingdom. He's the front-runner to replace Keir Starmer, who announced yesterday he's stepping down as Prime Minister. The BBC reporting 2 Labour MPs are considering challenging Burnham. Iran says $12 billion of its frozen funds are set to be released as part of ongoing talks with the US. Tehran is reportedly set to receive 2 installments of $6 billion apiece, but the US has yet to confirm the Iranian reports. Chicago Fed President Austin Goolsbee remaining concerned about inflation and questioning whether the factors driving up prices are truly temporary. Goolsbee calling out a rise in services pricing, quote, disturbing, and saying pressures there can often be more persistent. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thank you for the update. Up next on the programme, SpaceX falling back to earth.
The key story is tech boom. and that's going to be the most important.
Everybody knew SpaceX was going to be big.
Demand was off the charts. They're totally overvalued, and it's so obvious.
Up next, we'll catch up with Pierre Ferro of New Street Research, live from New York City. You're watching Bloomberg TV. So typically when I wake up in the morning, the first thing I look at is the Treasury curve. Over the last few months, I've looked to crude. I wonder how many of you wake up first thing in the morning stateside and look to this, South Korean equities, because so many people have piled into two names. The Kospi, another wild ride overnight, triggering circuit breakers, dropping as much as 12% at one point, closing lower by 10%. And in many ways, that sets the tone for today's session. Equity futures stateside, rolling over. Nasdaq futures underperforming. On the Nasdaq this morning, we're down by close to 3%, negative 2.8 so far this morning.
Yeah, and if you look at SK Hynix, which is one of the two names really driving the Kospi, it's down more than 13%. It speaks to a concern of how high-flying some of the performance has been of these stocks, that any little rumor that potentially they can't keep accelerating their earnings to the same degree will cause the momentum to just fade, and that is what we're seeing this morning.
SpaceX, one of those names under pressure, under surveillance this morning. SpaceX falling back to earth.
The key story is tech boom, and that's going to be the most important.
But we have to be wary that it's not going to last forever.
Everybody knew SpaceX was going to be big.
Demand was off the charts. They're totally overvalued, and it's so obvious.
Here's the latest this morning. SpaceX shares dropping for a third straight day, erasing $600 billion in market cap as the aerospace giant announces plans to sell investment-grade bonds for the first time. Pierre Ferro of New Street Research maintaining a buy rating on the stock, a 165 price target. Pierre joins us now for more. Pierre, welcome to the program. The difference between correlation and causation, what's the connection, if there is one, between that debt offering and this stock performance?
Well, I don't think the debt offering is like a significant trigger on investment sentiment. We knew SpaceX had like a bridge loan of $20 billion and was set to refinance it ASAP. Same thing for the acquisition of Anysphere, the owner of Cursor. These things were well known, so I don't see that as being a direct connection, to be honest.
So, Pierre, what do you think is the reason for the underperformance over the past couple of sessions, albeit still above where it first traded or where it was first sold, and albeit still above or just around $2 trillion?
Yes, exactly. So I think like the initial reaction of the market was very positive. There was like a lot of demand for the stock. Everybody wants to participate to this dream. What a beautiful story. This is space exploration. This is like throwing data centers in orbit. And these two things, really, space exploration, throwing the data centers in orbit, are 2/3 of what makes that stock worth close to $2 trillion, or take like the valuation above $2 trillion. And only 1/3 of the stock in the way we value the company really relates to much more tangible and near-term businesses, which are basically Starlink, like the telecom business. So you look at sentiment on AI. These days, I think investors are concerned. They are hearing about companies like blowing up their token budget and reining back on AI spending. So there is like a negative, like a cautious AI trade around that probably weighs on the stock. And then, approaching like almost exceeding like $3 trillion at some point in valuation, of course, triggers profit taking, because investors know that most of the valuation is a very, very long-term story.
Does it concern you, Pierre, that all of the tech names are kind of trading in tandem this morning? That yes, you've got semiconductors down, but you also have hyperscalers down. You also have SpaceX down. Even though some earnings are better than others, there has been the delivery on some side, even if you still haven't really seen the numbers in the likes of SpaceX.
Yeah, it's interesting to see that, as you say, numbers are probably going to look very, very good. We're very, very confident, like the near-term outlook for all the tech space is actually looking very, very good. The issue really is sentiment, and sentiment doesn't wait for numbers. That's usually how it happens. It anticipates numbers. So sentiment, as I said, is really about, we've been going through 6 months during which like AI frontier labs were adding several $1 billion of additional recurring revenue every week. And now we hear like the CEOs of very large, very advanced tech companies like Uber talking about having to rein back on AI spending, and that's, I think, going to cast like a shroud of concern and caution in the space environment. The good thing is that as we go through numbers, they're going to be reassuring, but that's going to be this quarter's numbers, the guide for next quarter, and I think the concern might hold on a longer duration.
Pierre, when it comes to SK Hynix and Samsung, this comes at a time when last week Apple said they were raising prices because of, quote, unsustainable memory shortage. Then why are these companies lower?
That's a very good question. That's where the market is being smart. When you hear Apple complaining basically about memory pricing and saying, well, I'll have to increase the price of my iPhone because memory prices are too high, what does that mean? That means they're going to destroy demand. They're increasing the price of iPhones. Less people are going to be able to buy iPhones, and that's going to reduce memory demand. And so memory as a business overall remains what it is. You have a certain amount of production capacity. If you have more demand, prices go through the roof, and if you have less demand, prices collapse. And even if you have like this very strong demand from AI, you still have like a very, very large portion, nearly half memory demand in volume still comes from PCs, smartphones, the broader like data center and compute demand. And if you have memory destruction in these markets, there is a risk that we see like a pause in the very, very high pricing environments that we see at memory. And when you look at where these stocks are trading, you know, at like double-digit multiples of their COG. So if you forget like the outsized profits they're doing at the moment, stocks in memory are actually very, very expensive. So investors know that, and that makes them very, very cautious about it.
Yeah, is that one of the reasons why you're neutral on Apple, neutral on that stock?
On Apple, we're neutral just because it's very, very healthily valued with very limited upside potential. That's the reason why we are neutral on the memory stocks, yes.
Pierre, appreciate it. Thank you, sir. Pierre Ferro there of New Street Research using the phrase demand destruction with regards to Apple.
So that's what I've been thinking about. Since he said that, I was thinking, can I use that excuse with my kids? Can I excuse it? I'm sorry, it just destroyed my demand when I saw that ticker price. I mean, at what point does Apple have pricing power, and at what point can they pass along the extra costs of memory chips?
Wall Street Journal, after they had that interview, did the pricing, and the iPhone 18, if it comes out Pro, would cost $1,299 because of the higher cost in memory chips. $1,300 for a new iPhone? I mean, that is going to be a bit of a tough sell, but I'm not sure.
You know what happened to me? We went to the Apple store. I mean, you might load up early because ultimately, you know, get ahead of that. Look, I don't know. Let's see if that actually happens.
Is that what you actually did?
Hoarding. You're buying holiday gifts now in the summer.
Like what I think.
Real inflationary behaviour there.
Well, to get ahead of it.
Yeah.
But I don't know that I'm alone.
Starts the spiral.
I know. You're already creating wage spiral single-handedly, so there you go. So I'll just do the other side.
I do my best to do that.
Oh, good.
Everyone should demand higher wages.
I know. Well, that's the reason why they're going to hike rates.
Absolutely.
There you go.
There you go. Next on the programme, Phil Camporelli of JPMorgan Wealth Management, Henrietta Treyz of Vader Partners, Matthew Whitheiler of Wellington Management, Neil Dutta of Renmac, with a very interesting take on the Kevin Walsh-led Fed. All of that in the second hour of Bloomberg Surveillance.
I think the economy has demonstrated its resilience.
The committee is fed up with inflation.
We should see the evolution of this committee moving now into a more hawkish direction.
It is a premature conclusion that we actually have a hawkish bias.
If inflation doesn't start moving his way pretty soon, he's going to have to hike. Period.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your price action scores look like this. Equity futures on the S&P 500 pulling back following losses in Asia, big losses in South Korea. On the Nasdaq, we're down by 2.7%. In the bond market, yields keep declining, resuming that decline following a big move higher. More recently, the two-year closing at the highest level we've seen in more than a year. We're down this morning by 3 basis points on twos. Encouraged by this move in crude. Crude comfortably in the 70s on Brent and WTI. Brent at 77, WTI at 73, just a whisker away from wiping out the post-war rally. The week ahead shaping up as follows. More economic data on deck. We've talked lots about PCE coming up on Thursday. Coming into view, Micron, a day away. That earnings report taking on more and more importance as this tech sell-off gains some steam.
Yeah, and one of the key questions right now, especially after the SK Hynix sell-off overnight, is are they going to double down on the higher-end AI chips? Are they going to double down on the areas of more expensive deployment, even though an increasing number of companies are starting to push back on the expenses of artificial intelligence? Can they keep up? Can they keep up the profitability? These shares have rallied 880% over the past 12 months. It is a pretty high bar, and people are getting nervous. At the same time, this is the transfer of wealth that we have seen in the markets.
Dan Ives just put out his note, following on what I said last hour. Didn't mention the Yankees or the Mets, but he said he views the Kospi sell-off as a pullback breather in a market up almost 100% this year, and also believe SK overtaking Samsung was a big symbolic move that caused investors to worry about this overheated memory chip trade. But what I go back to my question to Pierre Ferragu is, how does that make sense when Apple is saying we have to actually increase our iPhone prices because it's unsustainable when it comes to the memory chips and being able to get a handle on it?
You mentioned Pierre. We just caught up with the analyst from New Street Research just moments ago. He used the phrase demand destruction. Demand destruction for Apple, and I wonder how much further out the supply chain you can talk about that phrase, demand destruction. Does that breathe some life into the sell-off elsewhere?
One chart that really stood out to me from Dan Curtis at Bloomberg TV was that the cost of tokens, the amount that people pay to use some of these large language models, has gone down in tandem with the price of the hyperscaler shares. There is a fear that people don't want to pay for this. Uber pulling back, some of the own hyperscalers themselves saying, look, stop it with the vibe coding. If you're not going to have some sort of actual profitable project, let's not do it. This, to me, is some sort of pushback. I do wonder, though, on the consumer pushback about what you're actually going to see, because so far we haven't seen nearly as much demand destruction with higher prices as people expected.
Futures down this morning with negative 1.3 on the S&P, negative 2.7 on the Nasdaq. Coming up this hour, we'll catch up with Phil Camporelli of JPMorgan, with tech dragging down equities, Matthew Wittheiler of Wellington Management on a 3-day route for SpaceX, and Neil Dutta of Renmac warning the Kevin Walsh-led Fed could pose a left tail risk to investors. We begin this hour with stocks sliding as the latest rotation out of big tech weighs on markets. Phil Camporelli of JPMorgan Wealth Management writing S&P 500 and Infotech multiples are both trading below December levels. It would make sense to see more cyclical sectors take part in the second half of the year if we move away from geopolitics. Phil joins us now for more. Phil, good morning. Good to see you, buddy.
Good morning. Good to see you.
What do you make of the nervousness around the tech trade just in the last 24 hours?
Yeah, so for us, this is a kind of a normal thing with a market that has been up so much this year. However, as I wrote, it's kind of the opposite of a bubble. A bubble to me means go pay up for these stocks indiscriminate of the fundamental earnings story. And what we're seeing on both the S&P and, as I mentioned, the information tech sectors is that those multiples are lower today than where we were coming into the year. It's been all driven by earnings. John, and I love this stat. I keep thinking about this stat, given what happened in the Kospi overnight. There's a 30% increase in the supply for chips and an 80% increase in the demand for chips. I mean, that was like the story of me trying to get tickets for the Knicks for the finals, right? Like too much demand, not enough supply, and I think that's something that we'll continue to think about. However, the rotation is also front and center. If we're moving away from geopolitics, and if rates, in our opinion, it's a close call, but we don't think the Federal Reserve is going to move policy rates this year. I think that sets up for a nice rotation. Financials for us is a front and center trade driven by really good earnings inflections higher, loan growth based on a resilient consumer, as well as share buybacks and dividends. Like, it's all adding up. And financials through yesterday were negative. That sector was negative year to date compared to some other sectors that obviously
I'm curious where you stand on small caps with regards to the threat of the risk of rate hikes.
Yeah.
We've had a decent rally. Year to date up nicely, outperforming record highs on a Russell at the close as of yesterday. Despite the firming up of rate hike bets in this market, Can we carry on standing up in the face of that?
Yeah, so we'd rather the large cap story than the small cap. However, of the view that the Federal Reserve, again, close call, but won't move rates this year, and that we want to be pro-cyclical. I mean, everybody was caught on the 9 of the 18 last week, believed that there should have been a rate hike. I was more impressed with their views on above trend growth for the next couple of years, right? So that's kind of a pro-cyclical story for small caps. And as long as you don't get the Fed rate hikes, it won't be bad. However, we still like the U.S. large cap story versus small cap.
There is a sense, though, that if the hyperscalers keep the capex where it is, and you do have the investment and shares of those names continue to go up, then you're going to see inflationary pressures that are going to worry the Federal Reserve. Yeah. Don't you see that as something of a counterpoint to this rotation?
Yeah, so that's why it's a close call, Lisa. And you know, I keep going back. I totally take your point on the capex, but I keep going back to the labor market of where true inflationary pressures could arise from. And with wages right now below inflation, negative real wages, and the quits rate, I love looking at the quits rate as part of JOLTS. That's, for me, a very important indicator. Do I want to take this job and shove it and go find another job that has a higher wage? That quits rate is at cycle lows right now. So for us, the bargaining power from the U.S. employee just isn't there. That will not allow inflation to stick at these levels. Our view is that we're going to see peak rates and peak inflation in the second quarter of this year, which sets up for a really nice second half of the year.
So, and I'm glad that you don't want to take the job and shove it, because we love having you on, and I hope that you stay for a very long time. And there is a sense, though, that there is some pushback from investors starting, right? And a little bit, whether it's just SpaceX or whether it's beyond, that investors are getting a little bit nervous about how much money is getting raised. Does that make you think that maybe we're at an inflection point in terms of, you know, maybe we're not going to lend you $20 million to go to the moon? $20 billion.
Yeah. So that's where the rotation comes in, Lisa. So put it this way. We write about AI on the 6 months ahead, the 3 years ahead, and the 10 years ahead, right? We believe in this trade. That's a structural, generational trade. At the same time, though, the rotation trade is front and center for right now. So yes, again, that SpaceX, for example, was 4 or 5 times oversubscribed. There's still $22.5 trillion sitting in checking accounts, savings accounts, and money market funds. Liquidity is everywhere. Okay, so and then you add on top of that the share buybacks, and there's I don't think there's an oversupply of either IPO or even debt issuance right now. So I don't think that's a technical problem. However, you have to rotate to places that have underperformed. And again, that's where kind of that financials trade comes in for us.
Phil, what do you make of the fact that Austin Goolsbee yesterday was talking about some inflation may be coming off when it comes to the tariff hit, when it comes to gasoline now is under $4 a gallon across the United States. But he pointed to services. The fact that we've seen it in services, which historically is pretty persistent, is a little more disturbing. Yeah, so I would call that a high-class problem, right? It comes from the fact that you have a consumer that's more resilient. And I keep going back to that top 20% of earners. The top 20% of earners in this country do roughly 50% of the spending. And they only spend, 2.5% of their income on gas, oil, and electric. So I think that's where it's coming from, kind of that top-end, high-end consumer that's keeping consumption strong. And I just don't believe that service sector inflation is a problem. I mean, we're talking about 1 or 2 hikes being priced in. That's like lowercase hawkish, right? That's like tinkering. Like I don't see that as a problem. So you think inflation is only an issue for the upper cohort of society?
No, I think service sector inflation by itself is a symptom of an economy that's actually pretty strong and a consumer that's pretty strong, which will then lead to the earnings story, right? Nominal growth drives earnings, real GDP plus inflation. So I think that's actually an okay problem.
So at this point, do you think that the market is pushing back in any way, shape, or form? Because right now it seems like the market is cheering the idea of rate hikes in the face of inflation. You've seen lower end rates come down. You've seen this idea of stocks continuing to rally, the rotation still intact. Yeah. Where's the pushback? Why wouldn't they want to hike rates? Because right now the market is saying this is a good thing. And frankly, this is actually going to ease financial conditions for the people who need it the most.
Yeah, so so the question is, why wouldn't they want to hike rates at this point? You know, I think policy error is still front of mind, right? Either way, I don't think that this economy needs a rate cut for sure, but I think a rate hike at this point would be of the belief that inflation was going to continue to increase into the third and fourth quarter, which we don't agree with. I think it's more of a Fed on hold. I think that's where they want to be. Remember where we came into this year. There was 3 easings priced in. So I think the fact that we're now at we're now at a hold is a really good sign for the economy that it could withstand it. And again, this all kind of goes back to the fundamental story of growth and inflation. It's not just inflation. The growth plus inflation story, I think, is going to drive some pretty nice earnings.
You know, in this seat, I say this as someone with the luxury of not having to make a call, but I'm trying to stay open-minded about the Kevin Walsh Fed. There are some people making a call that maybe they hike as soon as July. We've got no forward guidance, so people are filling in the gaps, the space on what they think the Kevin Walsh Fed now stands for. When I think back to the use of forward guidance, had a lot of benefits for different central banks. If I go back to the Bank of England under Governor Carney, when he talked about the benefits of forward guidance, I think at the time they had threshold-based forward guidance, whatever. He said that it helped to bind the hands of the committee so that you didn't get that kind of dissent. And I just wonder if that's the same reason we've got all these task forces. That if you put all these task forces together, you can't really make a call to move policy until the task force is complete. Now, as things stand, a week on, I don't know who leads which task force. I don't know how long those task forces go on for. And I find it difficult to imagine a committee that is aggressive about hiking interest rates before those task forces are even complete through the summer.
That's why I have the end of August circled in my calendar, because at Jackson Hole, they're going to come out and likely have enough time to have some sort of conclusion from those task force. The actual time frame sets it up perfectly because they said they were going to move quickly and certainly by the end of the year, probably by September, have some conclusion. So if you think about where this is lining up, that's the reason why people are looking at September as the potential for a rate hike.
Neil Dutta joins us in about 30 minutes. He's going to have his own views on all of this, but it's a question we've asked repeatedly in the last week. Are we confusing the lack of guidance for hawkishness? Do you think we might be?
And I think, too, again, the headlines last week with 9 of the 18 wanted some sort of move higher in rates. But I go back to the 12, like the 12 voting members. And I'm not sure how many of those 12 really want a rate hike. And again, if we're sitting here 3 or 6 months from now and oil prices are where they are and is shaving off elements, and Annmarie, maybe it's a service sector story, who knows, that could be more sticky. But if that headline PCE number is coming down because oil prices are coming down, I just don't know why they would want to move rates higher. That's not obvious to me.
We'll see. Phil, it's good to see you. Thank you, buddy. Thank you. Phil Camprodi there of JPMorgan Wealth Management. With yields this morning down 3 basis points, 419 on twos. With an update on stories worldwide this morning with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Iran is trying to sell oil to Asia's largest buyers as a U.S. sanctions waiver takes effect. Tehran is eager to find a wider range of buyers and to clear oil currently in tankers, with at least 80% of the volume on the water not having a clear destination. South Korea's Kospi tumbled into the close Tuesday, triggering circuit breakers twice. The index ended about 10% lower, marked its worst day since March 4th. The benchmark chips giants, SK Hynix and Samsung, led the broad sell-off, both declining at least 11%. Apollo is once again limiting withdrawal requests from its largest non-traded private credit fund. The firm capping withdrawals at 5% of outstanding shares after investors asked to redeem nearly 17%. Apollo reporting most requests came from offshore investors. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the programme, championing economic strength.
The way we're doing it, we have the opposite of a depression. We're doing really well. We're setting records. We have the strongest economy we've ever had.
Up next on the programme, Henrietta Treyz of Vader Partners, live from New York City this morning. Good morning. Stocks down across the board. The follow-on from Asia into Europe, into the US session. We're down by 1.3% on the S&P. On the Nasdaq, we're down by 2.7%. If we check out the bond market, 2s, 10s and 30s rallying so far this morning. On the session, we're down by 3 basis points on 2s to 419, on 10s just south of 450. And if we finish on crude doing the White House a bit of a favour here. We're down to 77 on Brent, 73 on WTI. Under surveillance this morning, championing economic growth.
The way we're doing it, we have the opposite of a depression. We're doing really well. The numbers are incredible. The oil is at a level that nobody's ever seen before. Oil prices are way down. I think they're very comparable to what they were. We're setting records. We have the strongest economy we've ever had.
So here's the latest this morning. The president aiming to further his message of economic strength in a battleground district in Pennsylvania today, as voters see rising prices going into the midterms. Bloomberg's Tyler Kendall joins us now from Washington with more. Hey, Tyler.
Hey, John. Well, this will mark President Trump's first public event outside of Washington since the ceasefire was extended over the weekend. As you heard President Trump there, the conflict in the Middle East has only supercharged the conversation around the economy, which does still remain, of course, the top issue for voters as we head into November. We are expecting President Trump to say that a potential resolution to the war will help bring down costs and also tout his domestic manufacturing push as he's set to visit a key industrial base and a Mack truck facility. But a new Fox News poll underscores the headwinds that the president is facing, with only 12% of U.S. voters saying that they feel that they are getting ahead financially. Now, historically, polling data typically shows us that Democrats have trailed Republicans when it comes to trust in handling the economy, but the recent numbers and trends show that Republicans are indeed losing ground. And perhaps the urgency is being underscored by the fact that this will mark President Trump's fifth visit to the key battleground of Pennsylvania, and this is a very key district with a vulnerable Republican incumbent. Now, John, we have seen some moves recently here in Washington to tackle affordability issues. Just yesterday, the Senate finally passed what was considered to be a long-awaited bipartisan bill geared towards housing affordability and housing supply. It is going to be an issue that both parties try to claim stake to as we head into November.
Tyler Kendall with the latest. Tyler, thank you. Down in Washington, to build on that, Henrietta Treyz of Veda Partners writing, the time is right for 2028 presidential hopefuls to start distancing themselves from the Trump administration's second term and the Iran war. Henrietta joins us now for more. Henrietta, welcome to the programme. We've learned that's not helpful in primaries. Is it helpful on the international, or rather the national stage, in a general?
The Iran war is universally unpopular, even amongst Republicans. It polls at what is very low for President Trump amongst his very devoted base at 70%. The majority of Americans, I think that the last number I saw was 69% of Americans writ large disapprove of the war. And that includes 78% of independents. And those are, of course, the core voters that you're going after in any kind of election cycle, the midterms, a presidential. And so you see Republican presidential hopefuls. I'd point to Ted Cruz in particular as members who are trying to stake a claim down a lane that isn't directly descendant from President Trump, like a J.D. Vance or a Marco Rubio. If you're not in the administration, the Iran war is uniquely unpopular with the American public. It's a great opportunity to start to differentiate yourself from your other, contenders.
Henriette, if you're J.D. Vance, though, do you want to be the face of the negotiations that end the war? Or do you think potentially he should have maybe suggested the Secretary of State, Marco Rubio, to handle that?
Yeah, I mean, this is really making lemonade out of lemons. The war hasn't been popular from the jump. It has only gotten less popular, which is very normal. But both Iran and Pakistan and, of course, the president did himself a huge favor by getting J.D. Vance, who has historically been opposed to war, opposed to forever wars, and a very vocal opponent of specifically going to war with Iran. Now he is the one in Switzerland doing the negotiations at the front lines. So it's, I think, a very savvy tactic on the part of President Trump to get J.D. Vance in here. It's going to be a problem for him later on down the line.
What's going to be the response from Congress as Iran is saying that $12 billion of its frozen funds were set to be released, and the United States released this oil waiver where Iranian crude could trade on the international market legally?
Yeah, it's amazing. I used to think that the most incredible about face for the Republican conference was going from being pro-free trade and anti-tariff to now supportive of a effectively global tariff regime. And this is, I would say, pretty much on par with that. The Republican conference has voted for Iranian sanctions for decades. And they have passed legislation, including under administrations going 3 or 4 back, saying we want these sanctions. We want to squeeze Iran. They are state sponsor of terrorism. We will give them no ground. And here you have the Treasury Secretary signing his name on the line, giving a general license for immediate waivers on exactly what Republicans have tried to prevent for the last several decades. So this goes back to sort of the presidential argument. You're getting every presidential contender, Rubio, Treasury Secretary Bessent, J.D. Vance, on the record saying not only do we support sanctions, but we're going to make them go through before we even debate the nuclear file while Israel is at war in Lebanon. I mean, it's pretty astounding.
Henrietta, when you take a look at the top three macro risks, and it speaks to what you're talking about with the Middle East, the unpopularity there, as well as some of the way that the White House has navigated it, and that's related to the inflation risk. Torsten Slok put out its Middle East, its inflation outlook, and its artificial intelligence. It comes at a time where the U.S. administration is increasingly investing directly in AI-related companies, quantum computing being the latest target spot. How is that playing with voters as well as potential candidates trying to get to the Republican ticket?
You know, I think if you were able to tie this into how am I going to benefit? How does this help me? You know, I like to hear the idea that America is making so much money off of an Intel stake, but I do not like that I'm paying close to $4 in gas. And I was paying $2.81 at the beginning of the war. So it's very abstract for the average American voter. And that's why you see the president's approval rating on his handling of the economy is at 33%. Those are astronomically low numbers. So you get this directive. It's kind of like the stock market is booming. Well, that's awesome, unless I'm part of the 50% of the American economy that's not invested in the stock market. You know, so it really is hard to sell to the average voter. And when I think of Republicans going into this election cycle, or any candidate, you don't want to pay attention to sort of the campaign contributions unless they're low dollar figures. Show me the individual voters who are out here supporting my campaign, not the big macro, hey, I just got $10 billion from Intel. It doesn't mean anything to the average voter.
Henrietta, we're just hearing from the president on a range of issues with regards to Iran, one on the nuclear effort to make sure they never have a weapon, the other on shipping, and the third point on frozen funds. I'm just going to read some of it to our audience. Iran has fully and completely agreed to the highest level nuclear inspections long into the future. This will ensure nuclear honesty. If they did not agree to this, there would be no further negotiations. Based on this and other major concessions being made by Iran, I've agreed to allow the Hormuz Strait to remain open with no further naval blockade. However, all ships remaining in place should be necessary to reinstitute the blockade, which seems at this point highly unlikely. So that is the nuclear effort and that is shipping. This is the frozen funds point. The money and/or sanctions the U.S. Treasury is releasing goes into escrow, controlled by the USA, and will be used for the purchase of food and medical supplies exclusively from the United States, including corn, wheat and soybeans from our great American farmers. These are things that are desperately needed by Iran. This is a humanitarian crisis. Henrietta, just briefly on that point, the third point on the frozen funds. What have we heard from Iran about that?
We have not heard the same language or verbiage around that. Indeed, they have said the $12 billion is coming in two different baskets, $6 billion at a time. As is very normal with trade negotiations, you get a different read from one side to the other. We've watched it how many times with China. I would say pay attention to what the president is saying here, and Vice President Vance echoed it yesterday, which is farmers. The farmers are in an extraordinarily bad way in the United States economy. That's why the president has taken down tariffs on agricultural inputs. Anything that uses steel or aluminum, a Caterpillar, Deere, big tractor, anything like that, got a tariff rebate on July 8th. And that's because the farmers are in very high bankruptcy levels. They're dealing with the tariffs and the closure of the Strait of Hormuz, extraordinarily high input costs for fertilizer, urea, potash, all that stuff. And it's a result of not just the war, but also Liberation Day. So the president is looking at a state like Iowa, where the Democratic candidate is ahead of the Republican candidate. You got a problem. So for the president to focus on Iran and dovetail it with farmers is very, again, astute, but it points to a political weakness.
Henrietta, appreciate it as always. Henrietta Treyz there of Vader Partners. The president talking about the amount of energy that's moving through the Strait of Hormuz. That's brought down crude prices more recently. The effort to want to freeze some of those funds, those frozen Iranian funds, controversial. We'll spend some more time on that in just a moment. Coming up on the programme, we'll also catch up with Matthew Wittheiler of Wellington Management on a 3-day route for SpaceX. Stocks down this morning. We're negative 1.3% on the S&P 500. On the Nasdaq, some negative follow-through from the session in Asia. South Korean equities, the Kospi down by close to 10% at the close. On the Nasdaq, we're down by close to 3%, negative 2.75. In the bond market, 2s, 10s and 30s rallying so far this morning on the session at the front end of the curve, down 3. We are negative 3 basis points to 419 and coming off the highs of the year at the front end of the yield curve as these rate hike calls continue to build from the likes of Deutsche Bank, Bank of America, BNP Paribas, and others.
Yeah, and not just for one rate hike, by multiple, with Bank of America calling for 3 later this year. A key question here is how much is this offset by some of the oil prices that have been coming down, and how much is this really just the fundamental strength in the U.S. economy that's shifting up the growth rate and R-star? And increasingly, that's the discussion, something that Fed officials are not pushing back on.
A bit more of the latter, I think, because these rate hike bets are firming up even as this move in crude fades. Crude this morning almost taking out basically the whole rally post-war. WTI this morning trading around 73, Brent at 77. Remember, crude was trading in the high 60s before this war started, and here we are at 73 on WTI. And the president just moments ago talking about the amount of barrels that have moved through the Strait in just the last 24 hours.
Yeah, he's talking about 19 million barrels of oil flowed out of the Strait of Hormuz yesterday. He's calling this an all-time record, and oil prices are tumbling down. You have to look at what is actually happening, almost less than the president says. The fact of the matter is, to this market, barrels are moving, and it's not just vessels that have been trapped that are international vessels. This administration is giving a waiver to allow Iranian crude to flow normally on the international market. We could see a scenario, it would be very weird, but we could see a scenario where legally a U.S. refiner could buy Iranian cargoes.
Which is unthinkable to think about. As you've suggested, probably won't happen, but unthinkable. 2 hours away from the cash open, the opening bout just around the corner with some morning movers, some single names. Yahara has more. Hey, Yahara.
Hi, John. The tech sell-off is punishing some of the market's high flyers of the year the most this morning, with chip and memory names like Micron, Marvell, and AMD all sharply lower in the pre-market, and it mirrors what we saw over in South Korea overnight, with the Kospi down nearly 10%, as you said, and it was the memory names leading the sell-off, particularly SK Hynix, after this report came out that it may be slowing production of its AI memory business, shifting toward traditional DRAM chips. That sparked concerns about demand just in time for Micron earnings tomorrow. That name down 7.4% in the pre-market, and this just dramatically raises the stakes for that name. Another tech name selling off is Alphabet, down nearly 2% in the pre-market after it suffered its worst day since May of last year yesterday, with a 5% drop. And that came after 2 high-profile AI leaders left the company in just the past 2 weeks. One left for Anthropic, the other for OpenAI, and it raises questions about whether Alphabet can stay one of the leaders in AI that the market has rewarded when top leaders in that area are leaving the company. And I managed to find one bright spot, and that is IBM. Shares are rising 4.6% in the pre-market on a trio of positive catalysts. First, you have the company announcing this partnership, a cybersecurity partnership with OpenAI. It picked up an upgrade from analysts over at JPMorgan, and President Trump singing its CEO high praises yesterday at a White House event. John?
Yahara, that's happened to stock. We'll catch up with you in the next hour. Yahara, thank you. On our radar this morning, the story just breaking just moments ago. President Donald Trump saying funds from lifted sanctions on Iran will go into escrow. The president posting on social media that the money will be used exclusively to purchase U.S. agricultural goods for the people of Iran.
So even if that is true, it does mean the regime has more access to funds, so they can move money around. If they're going to use their escrow money for humanitarian, they can use the remainder of the funds they have within their control to rebuild their military and send this money to proxies. The proxy issue was a red line for this administration, for this president, for years, and it is not addressed in the MOU. And now the regime is getting more money. As you mentioned, this was a huge talking point. The Republicans would push back on Democratic administrations when they said they were giving money to the regime from escrow for humanitarian purposes. Well, they just moved money around, and they still have more money left to use on nefarious issues.
I feel like I've seen this movie before. It's just the president had a different name in the White House.
This is turning into something of the same kind of quagmire when it comes to political and geopolitical strategists. A lot of this is how do you make a deal palatable that on one hand is sort of back to the future when it comes to some of the sticking points in the past, but at the same time did get national gasoline prices on average down to $3.93 from as high as $4.56. And really this is the key stimulus going into the midterm elections that the president is trying to effectuate. So this is the end goal. Question is, how do you sell it on the way in?
I think you can make the case this morning that elements of Operation Epic Fury were successful to degrade the military capability of Iran, to ensure that we have this focus on ensuring they never have a nuclear weapon in the way that the president describes. Good things. Some people might argue we were close to that already before. We are where we are. Operation Economic Fury, which is something the Treasury has touted repeatedly, I think you can make the argument that that has totally failed. We talked about a blinking contest between the Iranians and the US. And based on the commentary coming from the president, the US blinked first with this quote: "I didn't want to see economic catastrophe. If you kept this going, that could have happened." And I think that tells you a lot. That statement's very loaded about the way they viewed current negotiations and the prospect of things get a lot worse for the rest of the world from here.
Right. And you think of a carrot and stick approach. Right now, we are front-loading the carrot when it comes to these nuclear negotiations. We are in the middle of nuclear negotiations, and up front, we are giving Iran economic levers to use when it comes to not just the money in escrow, $12 billion reported today from these funds going to Iran, but also the fact that they can now just ship their crude for market pricing, not having to degrade their pricing to China because it's sanctioned, market pricing using our financial system till the end of August.
Might not be a good idea to have a blinking contest economically with a dictatorship versus a democracy. Just going to throw that out there.
Well said. And for markets right now, markets do not care. And we've used this word agnostic repeatedly. Markets could not care less what the contours of the deal are, what the MOU looks like. They're following the barrels are moving. That's good news. Crude's back in the 70s. Let's move on and talk about tech. SpaceX. The Elon Musk-led company shedding roughly $400 billion in Monday's session alone, the second largest single session drop in market value on record. Matt Whitheiler of Wellington Management writing it's unique in that it's one of the few companies that can talk about a future that doesn't exist and get credit for it in their price. This is exactly how Tesla stock behaves. Matt joins us now for more. Matt, good morning. Good to see you.
Good morning. Thanks for having me.
Does that make it difficult to bet against Elon Musk?
It definitely makes it difficult to bet against Elon Musk. When I think about the companies out there that can go public and be trading at a $2 trillion plus market cap, there are very few that could do it with the current financial stats that SpaceX is delivering.
You're tracking this story. How close are we to the reusable technology, the advancements that we need to justify this market cap?
You know, I'm not a huge SpaceX expert, but what I think they have delivered is reusable rockets at scale. And I think they've proven a lot of that, which is in fulfillment of the vision, which the next step being vision of having orbital data centers. And when you look at the analyst reports and you look at how SpaceX is trading, obviously a lot of embedded value in that orbital data center story.
Masayoshi Son of SoftBank came out overnight and was talking about how he doesn't see data centers in space as the likely path of travel. He said it's really about the next couple of years and who wins the data center build out on Earth. As an investor in Anthropic, as someone who has been a participant in this whole space, in this race for AI, do you agree with him?
I do think there is a question around the long-term viability of orbital data centers, and I am not an expert when it comes to the physics, the math, and the numbers of getting these things up in the sky. But I think that the SoftBank point is right, which is today we are in a compute-constrained environment for inference. There is more demand for this inference compute for AI analysis and AI workloads than there is supply of that. And that ultimately is what's driven a lot of the performance in the market today, as we've seen the chip makers rally, as we've seen companies in the AI space in the public market like NVIDIA, like Microsoft, like Facebook.
Yeah, but is there starting to be some pushback in terms of the cost of that build out of capacity? Torsten Slok, I was mentioning him earlier, of Apollo, talked about AI as a risk and says, what happens if companies start limiting their token budgets meaningfully because they're only seeing weak return on investment? And this is something that people are pointing to, the idea that tokens are getting restricted. How much is this a risk factor for you as an investor in some of these top names?
I mean, it's definitely something we think about, but ultimately, I think you have to look at two things. The first thing you have to look at is what the companies purchasing and spending this capital are saying. And whether it's SpaceX with their recent bond issue and their IPO, or Google with their recent equity raise, these companies are saying that there is ROI here. It is sufficient for me to raise additional funds to go do these build-outs. And that's not because they are necessarily fueling others. It's also they see internal demand for this. So I think that's one thing you have to look at. And I think the second thing you have to think about is perhaps they're overspending in tokens today Almost certainly. But does that mean that AI does not deliver ROI across a wide variety of use cases? I definitely don't think so. And I think that the proof will be in the years that play out. Does Anthropic end up going from, I don't know, 2,000% year-over-year growth like they've been tracking today to, 500 or 700%?
But Microsoft just recently tapped DeepSeek, Chinese models, to try to offset some of the cost. Why is that not the path of travel for a lot of these companies?
I think that when you think about how the economics will flow in the model builders themselves, I think it's our opinion, or certainly my opinion, that the frontier models, the OpenAI, the Anthropics, the leading models out there will capture a lot of the revenue. But does that mean that everything needs to run at the frontier model level? Absolutely not. Is there a role for DeepSeek? Is there a role for open source? Absolutely. And I think that's how the market will bifurcate, is there'll be a lot of value in the large language models at the bleeding edge, and there'll also be value accrued to the open source and Chinese models.
When you look at SpaceX, who's really their competitor right now? Is it the Anthropics or is it the Blue Origins?
I think it's probably more the Blue Origins. And if you actually look at the economics of the business today and you look at how much capital the company is bringing in, a lot of their competition is actually the CoreWeave and hyperscalers of the world. If you look at their economic agreements with Anthropic and with Google, that accounts for almost $24 billion of annualized revenue that is coming from just leasing out their data center compute.
Matt, just finally, you're an investor in Anthropic. Can I get your reaction to how you'd characterize the messaging coming from leadership at Anthropic, which some people say is AI doomerism and is not helpful to the whole landscape right now? What's your take on it?
My take on that is that it may be perceived as doomerism, but if you look at how this administration is acting, and if you look at some of the reports that came out yesterday, perhaps the doomerism isn't as extreme as people had thought. I think there was reporting yesterday that perhaps the latest Anthropic model was able to breach some classified systems, and that is what resulted in the administration putting a lockdown on the Fable release that Anthropic had.
Now, I imagine when this goes public, you'll be selling the stock, right? Is that fair to say? You hold Anthropic now. When the stock goes public, will you hold Anthropic still?
We as a firm, as a $1.3 trillion asset manager, have lots of different pockets of capital, some of which may be selling Anthropic, some of which may be buying more.
Okay, so complicated.
Complicated.
I'm trying to understand how you think about this in the future, because clearly now in private markets, it's got a great valuation. It's coming public. There's a lot of stories, a lot of hype around it. And what helps the hype sometimes are these kind of declarations that it's going to wipe out 30% of white-collar work. You don't have to deal with the regulatory response just now, because they've created so much value in private markets. You've been a part of that value creation. How are you thinking about the prospect of regulation down the road? Is that a story you want to navigate with that company, or something you want to take your hands away and say, you're on your own now, thanks for the ride?
Well, I think it's definitely a complicated piece of the mosaic across all the AI landscape. And I think the trade-off ultimately comes down to how much regulatory flex does the government want to have in this space versus how much free market and leadership position we want to take. And I think that's the tension we're seeing today. And if you look back a week ago, I think there was some reporting that perhaps the U.S. government may start taking positions in some of these companies like they did at Intel. And I think that potentially could be a route, although I don't know.
Do political realities in your mind dictate one or the other? Is it easier to say in China, we're going to be market leaders and focus on that? And in the US, you just have to face the political reality that you need to control this thing, because the people that are voting are the people that are losing their jobs?
Well, I think that if you contrast the China approach versus the U.S. approach, I think you can mandate that we're going to be a leader and that we are going to win there, but that doesn't mean that you deliver on being the winner in leading there. And I think that's what makes the U.S. development of AI quite unique, is that we have multiple free market economy participants trying to build the best models. And so far, that has resulted in us having a lead in the model space.
Matt, this was thoughtful. We appreciate your time. Thank you, sir.
So much.
Appreciate it. Matthew Whitheiler there of Wellington Management on Anthropic and SpaceX.
Some people say that regulation will actually create some benefits for the existing models because it creates a moat around them. When it comes to the Mythos and Fable iterations, though, this is an increasing concern. How do companies catch up? And their spend is only increasing as they try to catch up quickly so they don't become vulnerable to potentially some of the incursions from some of this technology. A really complicated puzzle right now.
You need the ability to raise a lot of capital and raise it very quickly, both in equity and in debt markets. Let's give you an update on stories worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. President Trump posting on Truth Social about negotiations with Iran, saying he is allowing the Strait of Hormuz to stay open, but ships remain in place in case another blockade is needed. The president also said Iran funds being released will go into escrow and be controlled by the U.S. Chicago Fed President Austin Goolsbee remaining concerned about inflation and questioning whether the factors driving up prices are truly temporary. Goolsbee calling a rise in services prices, quote, disturbing, and saying pressures there can often be more persistent. Aerospace Intelligence winning a U.S. government contract to deploy AI air traffic control tools. The company has developed the tools to map out flight trajectories and identify potential congestion areas. The FAA plans to roll out the tech in the fall. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you for the update. More from Vonnie in the next hour in about 30 minutes' time. Up next on the programme, doubling down on price stability.
We've got some work to do on the price stability front. The way to get monetary policy right is to deliver on the remit that Congress gave us, to deliver on price stability. To be clear, the Fed will deliver price stability.
Up next, Neil Dutta of Renmac. Some negative follow-through from the Asian session out of South Korea. Kospi down 10%. Those two names getting absolutely hammered. We're down by 1.2% on the S&P. On the Nasdaq, we're down by 2.6%. In the bond market, a focus on these Fed rate hike bets. Yields pulling back this morning, down by 3 basis points. The 2-year, 4.19, 10s around 4.50. Under surveillance this morning, doubling down on price stability.
We've got some work to do on the price stability front. The way to get monetary policy right is to deliver on the remit that Congress gave us, to deliver on price stability. We have the capability and commitment to deliver on our price stability objective of 2%. To be clear, the Fed will deliver price stability.
It's the latest this morning. The start of the Kevin Warsh era has a clear path, with a new Fed chair expressing his goals for lowering prices. Neil Dutta of Renmac warning that Warsh's hawkish tone could pose a risk to investors, writing, "I don't view Warsh's communication strategy thus far as a positive development. Rarely have I thought of the Fed as a potential left-tail risk to markets and the economy. Now I might have to start." Neil joins us now for more. Neil, welcome to the programme, buddy. It's good to catch up. What was it about the communication, the news conference specifically, that changed your mind about how this Fed might be operating in the future?
Well, I think a lot of the defenders of the strategy are, sort of making the critique that, forward guidance is out of favor. People want to be spoon-fed the next meeting. I mean, that's not what this is about. It seems to me that people are making or sort of blurring the lines between forward guidance and just having a reaction function, right? I mean, I think people are, we need to know exactly sort of how they think about the data and how that will update their sort of distribution around rates policy. No one's asking for them to kind of pre-commit to a policy one way or the other. That's not what this is about. So I think Warsh, Chairman Warsh, sort of blurred the lines between those two things. They're not, in fact, the same thing. And, the risk, of course, with that approach is that we're not going to know the reaction function until the policy itself is announced. And the further the gap is between the markets and the Fed, the bigger the potential sort of market, gyrations could be when they do make those decisions.
So, Neil, let's talk about the prospect of those decisions happening this summer. I've seen the rate hike bets. You've seen them too. I've seen the calls come from several economists as well, including the likes of BNP Paribas. This is the point that BNP made. The emphasis on the results of the task force appear intended as soft forward guidance for the FOMC to wait until later this year before making a major policy adjustment. Do you see it the same way?
I don't. I mean, a lot of people are trying to do John, what seems to me to be like these, mental gymnastics, mental jujitsu in terms of trying to rationalize everything that came out of that press conference. I mean, I guess my concern is if the press conferences are meant to deliver some kind of dovish guidance later, the damage would have already been done in the near term, because it's pretty clear to me that by allowing this kind of information void to develop, that information, the hawks on the FOMC kind of fill that void. And the markets latched on to the next best thing, which was the dots plot. And by the time those task forces come to any conclusion, you may have already seen the Fed hike by September. So I don't really buy too much into that. I think that there's a lot of also chatter about how these are sort of pretenses for the Fed to move policy in a more dovish direction. I mean, that's not immediately clear to me either. I mean, if we're talking about adopting more of a, sort of an inflation data approach that kind of incorporates things like median and trim mean inflation, that's not necessarily dovish per se. There's no dovish bias persistently in those data points. So
Neil,
I don't really put too much stock in that either.
You said that the damage is already done. Where's the damage?
Well, I mean, the damage. Well, I mean, I said. What do you mean by that? I mean, I would just say
in terms of the rate hike. I mean, right now we're pricing in a rate hike, and the 10-year yield is below where it was on the day of the Fed meeting, and we haven't seen stocks massively sell off.
I don't know. The dollar strengthened. You talked about how financial conditions have tightened since then. Maybe that was the goal. But I do think the release valve of the dollar is quite interesting to me. The fact that the Fed appears to be getting a bit more hawkish while the rest of the world is not, that's putting upward pressure in the broad dollar exchange rate.
And that's
But I wouldn't say, I mean, look, the damage, I mean, these things don't happen right away. But at the margin, I don't think it's a particularly controversial thing to say that financial conditions have tightened since the FOMC meeting.
Yeah, there's also this concern, and you yourself have talked about how are we using the right inflation metric to really assess the inflationary pressures in the market. A lot of what people are focusing on is the task forces. That's all we got in terms of forward guidance, is that there are going to be task forces that are going to analyze these things. Do you welcome some of the reassessment of some of the benchmarks of the Fed's lodestar, which is the data?
Yeah, of course you welcome it. I mean, there's something to the idea about, the data are revised consistently and all the time, and they give you like very different messages about, maybe after the fact. But I also think a lot of that's well known, right? So to me, do we think that the Fed's not doing some of that already? I mean, this is an institution with loads of economists that are looking at all different sorts of data sets and cutting the data sets and analyzing the data sets every which way. So I definitely think it's worth updating, how you think about the data sets that you use. But I would just say that a lot of these private sector data sets, whether it's something like Revelio or ADP, I mean, that is not a great substitute. It's a great complement to the BLS data, but it's not necessarily a substitute.
And just finally, just to wrap it up, did that news conference make you bearish on this market?
No, not by itself. I mean, I just think it made me, I would just say, to me, it's a revealed preference, right? I mean, going in, there was this sort of view that Warsh was this dove. I don't really know what he is right now, and I think it's okay to kind of admit that. But to me, it's a revealed preference. By allowing that information vacuum to develop, who filled the vacuum? The hawks. And the hawks are squawking, and they're ascendant in the committee at some level. I mean, you must have known something like that was going to happen if you wanted to be so circumspect around your own views. So I think perhaps by not putting in a dot himself, he may be able to potentially absolve himself of the decision the committee ultimately makes, which is a rate hike in September.
Neil, thank you, buddy. Neil Dutta of RunMac. We've talked about that a few times. If you're not going to offer guidance, someone else will offer guidance for you. You're outsourcing communication to someone else, and to Neil's point, that someone else is the Hawks right now. Up next on the programme, we'll catch up with Kate Moore of Citi Wealth, Ted Mortonson of Baird, the former White House senior advisor, Amos Hochstein, and Brent Schutte of Northwestern Mutual.
The key story is tech boom, and that's going to be the most important.
The market can still go up.
I can't just tell you to sit here and hold your nose and sell.
The question mark around potential bubble euphoria does continue to build up.
We have to be wary that it's not going to last forever.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. And your price action, the scores look like this. We're down by 1.2% on the S&P 500. On the Nasdaq, we're down by 2.5. On the Russell, coming off record highs, we're down by 1.2 following this move. Overnight in Asia, South Korea, the Kospi getting hammered, plunging by close to 10%. SK Hynix down by 13. Samsung down by 12.9. A rough session. Over in Asia, setting the tone. for the market this morning.
Some concern on reports, local media reporting the SK Hynix is shifting to more DRAM, which is used in everyday consumer electronics, versus the more expensive, highly profitable AI memory components, in part because maybe that's where they see demand. Ultimately, the thought here is, why wouldn't they double down on the highest profit margin types of products? Well, the answer could be some of the anxiety that people have about how much capacity some of the hyperscalers have to keep spending the way that they have, given that the cost seems to just be getting higher and higher.
There's a concern that all of this is just overheating. I go back to Pierre Ferragu, though, the idea that potentially what Apple is doing in terms of raising their prices because of unsustainable demand for the memory chips basically means we might get demand destruction. And potentially is that some of what we're seeing right now play out in financial markets?
Elisa's talked about this countless times. The next big data point for this story is Micron earnings, and it comes after the closing bell tomorrow. On from that, a little bit later this week, you'll get PCE data on Thursday. In the bond market at the moment, twos running this morning, yields are lower, but twos are near the highs of the year at 420. In fact, twos are near the highest level we've seen in more than 12 months as we really firm up those rate hike bets at this Federal Reserve.
The reason why, when people say demand destruction, I am skeptical is because people have said that when it comes to oil prices, didn't see it. People said that when it came to airline prices, airline ticket prices going up, we didn't see that. When it comes to just basic consumer goods, that's the reason why inflation rates have been higher than a lot of people expected and going in the wrong direction, as Austin Goolsbee said of the Chicago Fed yesterday. It is because people have absorbed those higher prices. You haven't seen the demand destruction that you normally would with higher prices. So to me, that's the big question. How much heat is there in the economy to absorb higher prices rather than simply to have people stay
only
home?
Slightly laughing because when we talked about this, you said you're going out and buying all the products now before the price hikes come. So maybe it's hoarding.
Lisa went to Apple.
Yeah.
That's what happened.
I did.
Right?
I just didn't want to
demand destruction for the
prices.
18, but I'm going to buy the older models.
Okay, well, look. We can move on, but the point being, it wasn't demand destruction, it was demand acceleration.
Yes, which is what happens in inflationary spirals.
Correct,
right?
because
people want to get ahead of the price.
Exactly, so they buy more. It's sort of like toilet paper.
Textbook, absolutely.
Exactly.
Just like toilet paper. Where did that come from?
The pandemic.
Okay, yeah, yeah.
It's like hoarding.
I got long toilet paper.
Yeah.
I had tons. I should have sold
I know, you actually did really well with that, so I've got.
It's kind of sad that markets ripped through that whole period, and the greatest trade I made was stockpiling toilet paper.
Well, we all have our claims to fame.
There we go. Coming up on the programme, Kate Moore of Citi Wealth with stocks hit by a global tech sell-off. Ted Mortonson of Baird with SpaceX whipsawed by volatility. And a former White House senior advisor, Amos Hochstein, as the US greenlights Iranian oil sales. We begin this hour with stocks falling as the tech-fueled slide intensifies. Kate Moore of Citi writing, holding excess cash during inflationary periods carries a real cost. So any market pullback could create an opportunity to deploy capital. Kate joins us now for more. Kate, welcome to the programme. Is this morning that kind of opportunity?
It might be, but let me tell you something I'm trying to focus on. We've been watching very closely the speed at which all of these rebounds have happened over the last number of years, and particularly over the last, period post the pandemic. And the days of the rebound are getting shorter and shorter and shorter. So we're finding people step in even when they don't have great news, simply because they have that fear of missing out, and because they're being conditioned over the last 5 or 6 years that you maybe at most you have 10 or 11 trading days to get back in when there's a bit of a pullback. So I think I'll watch to see what happens over the next few days. But I would suggest that if you want to be longer risk, you can't wait too long. And the rest of the market has been trained to jump in very quickly.
So, Kate, the essence of the call, what underpins it, the epicenter, if you will, is this inflationary push on investors right now. They need to deploy capital. Why is that capital going to find its way to the US equity market specifically? Where are the other opportunities?
Well, I think we know the story that equities in general tend to hold their value better in an inflationary environment. But I think the very important point here is that aside from the demand destruction, I think we should come back to that point that may or may not happen as prices rise for all of the components and everything related to the AI and tech trade. The really critical point here is that most of what's driving the equity market we know is kind of more secular in nature and not necessarily just cyclical, even as some cyclical parts of the market have performed well. And I say this because even if there is some demand destruction in parts of the consumer, which of course we are not seeing at this point, or in terms of machinery and equipment orders and things that are affecting the industrial sectors, we still believe that most of what's powering the market is going to be earnings. And that's certainly what we've seen in the first almost 6 months of this year.
So, Kate, are you also going to the Apple store and buying up as much as you can ahead of price hikes? Or are you waiting for the price hikes, then you're still going to buy? I mean, how much do you see demand destruction as actually a thing versus people who are absorbing the prices?
Yeah, I'm not doing a ton of pre-purchasing. Full disclosure, though, at the start of the tariffs last year, was it just last year? It's pretty hard to kind of figure that out at this point. I did buy a couple extra pairs of running shoes in anticipation of challenges getting things over to the U.S. And the truth of this story is that I'm not as much of an Apple enthusiast as some other folks. I'm a big Google enthusiast, so it would be buying another Pixel. But I don't know that we're going to need to buy much in advance. But I am watching, though, there was a bit of an acceleration in terms of same-store sales over the course of 2026. We were kind of flagging this in a note that we're putting out this week, that we started off January and February at a very fast clip, much faster than the 2024 and 2025 experience, and it accelerated post the beginning of the Iran war, which is opposite of what most people would have expected. They would have said, hey, in the face of a conflict that's going to be causing broader inflationary pressures, consumers are going to pull back, and that's not what's happened. At the same time, we're seeing like small businesses continue to raise wages. I think it was a net 31% of businesses surveyed in the NFIB survey, basically saying that they raised wages or compensation over the course of May, and that many more were expecting to have to do that over the course of the summer. So, that's kind of the pressure I'm focused on, is that, in this inflationary environment, in the kind of competition for skilled labor, do we end up getting a margin squeeze for companies that are very labor intensive and who have not switched to AI agents as part of their workforce?
Kate, does it make you a little less concerned about inflation and a little bit more in favor of buying long-term bonds, given the hawkish tilt that we heard from the Federal Reserve, or at least that is perceived by the market?
I mean, I feel a little bit better than I did last week, especially given some of the yield movements. But I'm still not a buyer of duration, Lisa. I just have to say, I think you're going to get much better total return from other parts of your portfolio, particularly kind of risk assets, than you will from adding duration at this point. The hawkish tilt that we experienced last week from the FOMC, I think I read a bazillion notes on this and had many conversations with our own economists. We all agree was a little bit more than most of us expected. But I think it was also warranted because we've been flagging the breadth of inflationary pressures for some time, the percentage of PCE components, the percentage of CPI components that we're tracking at above 3% or 5% annualized rates. So I think it was warranted, even if it was a bit surprising, but it does not lead me to think that, the end is near in terms of inflationary pressure and that we should be buying the long end.
Do you feel more at ease given what we've seen in terms of oil prices and obviously gas prices now below $4 a gallon across the U.S.?
Well, I think it's certainly going to relieve a little bit of pressure as we go into the summer driving season. But we know that gasoline spend as a percentage of total spend has not been growing dramatically over recent years. I'll be interested to see if that lower gasoline prices lends additional support for some of that retail sales and consumer spend activity we were just talking about. But I will tell you that we see very little pockets of significant weakness in the U.S. consumer. And so it's more broad-based strength. And I think that's going to help to power, a sustained growth trajectory in the second half of 26.
Okay, we need to talk about this debt offering, the amount of supply we're getting. Just bear with me. Getting some news coming from SpaceX. The longest maturity I can see coming from this planned debt offering, we've reported on it, could be as much as $20 billion. Lisa, a 30-year offering coming from SpaceX. Multi-part offering, but a 30-year piece in the offering we're getting later today.
Yeah, 30-year space debt at a time when the promises are long-term. I'm looking right now that the discussion is around 200 basis points over benchmark rates, at least that is the talk right now, versus the average of 73 basis points. So, yeah, you are demanding a premium, although if you take a look at the maturities and you take a look at some of the other investment grade, the lowest tier of the investment grade universe, that's sort of in line. A question here about what the demand picture is going to look like, right? Are you going to start to get pushback? Because remember, us bond guys are bean counters. We want our money back with interest. We don't want to shoot for the moon, literally, because ultimately we have a cap on how much we can earn back. So at a certain point, do you start seeing skepticism about a company that hasn't shown the numbers yet and has promised quite a bit?
So triple B rated, just about investment grade. and I was going through the Moody's report that came out alongside that rating. And within that, they talk about the risk factors. And it reads as follows. Execution risk is further elevated by dependence on Starship V3. Technical setbacks or delays in achieving full reusability or ramping launch cadence would constrain the company's ability to expand network capacity, thereby pressuring long-term revenue growth, margin expansion, and the overall credit profile. Of course, that would be a risk for the credit ratings. That comes from Moody's. The problem that you have with the risk factor, to your exact point, which I think is the most important point with regards to this debt, is that if they are successful doing all of those things, you don't get the upside in the debt, you get the upside in the equity. And if they're not successful, you get all the downside in the debt market. So you've got to make sure that whatever yield you get on this debt, even if it is investment grade, it's right there at BBB, you've got to make sure it compensates you for that risk.
Yeah, not all BBB companies are the same, especially if the business model is somewhat speculative. And I know a number of credit investors who have said to me, look, I would rather own tech equities than the tech debt, given the potential upside versus the potential downside. Again, you're talking a pretty long time, 3 decades. I mean, in 3 decades, we might all be living on Mars.
Yeah, it could be a very different world.
I mean, maybe it'll be the best bet out there, but we just don't know.
Maybe he'll prove all the doubters wrong, but you're going to see the upside, to your point, in the stock. Also worth pointing out what the money's going to be used for. It's going to be used to repay the outstanding borrowings under a bridge loan facility in full. We kind of knew that, so that's not news, but it's worth considering because this isn't new money to go after new investments. That's important because there are people that follow this debt, particularly in the investment grade market, that will say this is not the same as Alphabet. It's not the same as the hyperscalers would say at AA credit. They have capacity to issue a lot of debt here before they worry about becoming junk. SpaceX isn't in the same place right now, which is why a lot of people think if you see more capital raising, you're going to see it come from the equity side of things, maybe more than from the debt side.
Yeah, and the equity side of things gives it a cushion. So you can say if you're a debt investor, look, at least you've got that cushion to absorb. But like you said, it's not tied to specific projects that potentially could be profitable in and of themselves. Also unclear whether it's secured by anything in particular. You can secure a lot of assets behind the hyperscalers that could potentially be sold to recoup some of your investments. So it's not exactly the same. And even then, you had some investors saying, if I'm going to invest in technology, I'm going to do it on the equity side.
OK, we wanted to spare you so you didn't have to talk about a single name, a specific company. But there's some of the dynamics right now on the supply side of things, in equity, in debt. When you look at the amount of supply we could see, the amount of paper being issued, the amount of capital being raised to fund these projects, is that a threat to this equity market?
I think it's something for us to be aware of. I'm not going to say it's an outright threat at this moment, but it is absolutely true that all of these companies that have been on rocket ships, and I say that really tongue-in-cheek, are being opportunistic about how they can raise capital right now, whether it's in equity issuance or in debt issuance. And that's generally a prudent thing to do. When your sector, your industry is hot, and when there's a tremendous amount of investor attention, like now is the time to strike. The one thing that we do have to recognize, though, of course, is that we've had a phenomenal run, and some of these names, and I'm not talking specifically about SpaceX, which is very new to the market, over the course of the last couple of years. And our experience is that clients are feeling and investors are feeling a little bit anxious about the concentration that they have in these names in their equity portfolio. So when we think about whether or not they're going to be adding significantly on the debt side as well, they have to say, do I want to take that much sector concentration risk on both the equity and the debt side of my exposure? And that, I think, is a question left to be had, or left to be answered, and something that we've been talking to a lot of clients about, especially as some of the well-known technology companies are appearing to be larger parts of the IG issuance.
It's becoming a bigger and bigger debate, that's for sure. Kate, thank you. It's good to see you, as always. Kate Moore there of Citi, with an update on stories worldwide, stories elsewhere, with your morning brief, your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. President Trump posting on Truth Social about negotiations with Iran, saying he is allowing the Strait of Hormuz to stay open, but ships remain in place in case other blockades are needed. The president also said Iran funds being released will go into escrow and be controlled by the United States. Andy Burnham is under pressure to outline an economic plan for the UK. He's front-runner to replace Keir Starmer, who stepped down as Prime Minister yesterday, or announced it at least. The BBC reporting 2 Labour MPs are considering challenging Burnham. The Senate passing a bill aimed at curbing Wall Street's influence on the housing market. The House will consider the measure today. The bill would block large investors from purchasing additional single-family properties. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you for the update. Up next on the programme, the morning calls, plus Ted Mortonson of Baird, with the tech sector rocked by major volatility in the last 24 hours. From New York City this morning, good morning.
the initial reaction of the market was very positive. There was like a lot of demand for the stock. Everybody wants to participate to this dream. What a beautiful story. I think investors are concerned. They are hearing about companies like blowing up their token budget and reining back on AI spending. Investors know that most of the valuation is a very, very long-term story.
That was Pierre Fadagu of New Street Research on SpaceX. SpaceX, a 3-day route, looking to arrest some of that move a little bit later this morning at the opening bar. That stock turning positive in the last hour or so. Equity futures still negative. We're down 1.3 on the S&P, down 2.8 on the Nasdaq. That's the price action. Here's some of your morning calls this morning. First up, Susquehanna initiating coverage on SpaceX with a neutral rating and 170 price target, citing strong growth prospects and demanding valuation. Second call from Bank of America, raising its price target on Qualcomm to 195, saying the company is re-entering a fast-growing but hyper-competitive AI market. That stock is down by 6.5%. And your third and final call from JPMorgan, upgrading IBM to overweight, seeing greater confidence in software acceleration in the second half. Their stock is up this morning for different reasons. It's up by 5% in the pre-market. Let's stick with tech. SpaceX turning positive this morning, looking to snap a 3-day losing streak of raising $600 billion in market cap. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, it's early days. I don't know whether to make too much of this or not. Where's the pressure coming from for this stock?
I mean, we knew, with the roadshow that there was a lot of retail interest. And look, this company hasn't even reported a quarter, and it's trading at this kind of valuation. And my sense is every time there will be a successful launch from SpaceX, that's going to change the narrative, drive enthusiasm. Same thing with an AI model release that they are going to have on the Grok side or Cursor side. So it will be very volatile, for anyone who is an owner of the stock, simply because this company doesn't have the sort of balance sheet that your hyperscalers have. And, a lot of the revenue is further out. So it's contingent upon these two things really going, in the right direction. And that's where there's a lot of uncertainty.
It does have the equity cushion that other hyperscalers have, Mandeep. What are your thoughts on how they're using it?
I think the Cursor acquisition was a great one just because it gave them a lot of credibility, around the coding agent market, which is among the most successful use cases of generative AI. And the fact that they can scale Cursor and really, deploy it with their compute, because Cursor didn't have the compute. So to my mind, that definitely was headed in the right direction, and that is why people got really excited. But there is no doubt that space launches and, the orbital data centers, that is where they have to show continuous progress. And there's a lot of steps that have to go right for them.
Mandeep, it's good to see you. It always is. Thank you, sir. Mandeep Singh there of Bloomberg Intelligence. To build on this, Ted Mortonson of Baird joins us now for more. Ted, welcome back to the programme, sir. It's good to see you. You say we're now in a game of duck, duck, goose. Can you translate for us? What does that mean for this stock?
So if you look at the last person in the pool, on the tech pool, we're now to the point where I don't think you can squeeze anybody more into the pool. And what I mean by duck, duck, goose, nobody wants to be the last guy without a chair. The exposures across both the hedge funds, the mutual funds, and the speculation and retail, and I've been doing this for too long, probably 35 years or so, it's pretty heady. So we're just in this cycle, I think, where we're massively overbought.
Overbought for which specific names? You're talking about SpaceX more specifically, or are you talking more broadly about the hyperscaler and tech trade?
I think if you look at the IGV, Lisa, the IGV is up 106%, the SOX is up 106%. The IGV, which is a software index, is off 17%. So when we talk about crowded trades, Micron up 325%, Marvell up 262%, ARM up 273%. I can go on and on. There's about 12 of these that are, I would say, on average up about 250%. That's a good decade of returns. And most of those returns have been attained since April 7th. So in 2 months, we've seen a historic melt up on a pull in of infrastructure into that cloud infrastructure area.
Ted, tomorrow Micron reports earnings after the bell. Could they do anything to make you think that it isn't necessarily an overbought name, given the fact that it alone is up 880% over the past 12 months?
The expectations are very, very high, and we're Where my clients are really focused is we've never seen gross margins where they guided at 81%. I mean, back in September of 25, they were at 45% gross margins. I mean, it's almost a historic move on the model, on not only pricing leverage, and I think to your previous comments, we're starting to bump up against enterprise elasticity of demand. These price increases of over, call it 20% plus, are impacting IT budgets. I mean, IT budgets are only up 4% year over year. They're getting killed by infrastructure, whether it be networking, storage, or memory cost. There isn't a lot of pixie dust out there to increase IT budgets just on a blink of an eye. So I think we've had a massive pull-in of infrastructure in the first half, and people trying to get in front of price increases and insulate themselves if there are any shortages on the supply side. They pulled in a lot of spend, and this is very indicative of what the cloud titan CapEx looks like.
So, Ted, do you think we see a bounce back from this, given the fact that potentially some of the drawdown we're seeing, what's happening in Korea, is because maybe individuals are concerned about demand destruction?
Korea is a different market. It's very speculative. The retail investors leveraged, through the roof. It reminds me of Bitcoin in the U.S. when the retail investor at the top was very leveraged. I think everybody in Korea on the retail side has leveraged their own internal balance sheet to play SK Hynix. So I think that's a special situation. I think where our checks are picking up at least a little bit of disturbance in the force on the hyperscale side is token costs are through the roof. And there is a lot of debate on the traditional foundation models, and I'm talking more about Grok, I'm talking more about Anthropic and OpenAI. What we need to watch if to lower costs, if a lot of these next generation AI companies move to open source models, specifically coming out of China to reduce token costs. Token costs are a real big issue out there.
Ted, appreciate it. Really well framed. As always, Ted Mortonson there of Baird. If you're wondering what's happening in this equity market right now, to understand the concerns that the bears have about some of the pricing, then you've got a decent clinic just there in the last 5 minutes.
Yeah, right now, just how many years of advancement are you pricing in at the same time? CapEx budgets are getting a little constrained at some of these companies.
The cost be becoming a bit of a casino, right? Bit of a leverage casino.
Bit is sort of an understatement.
10% move overnight, 10% lower. Coming up on this program, the former White House senior advisor Amos Hochstein with Iran set to restart its oil sales around the world. $60 minutes out from the cash open, the opening bout just around the corner. Equity futures trading lower. We're down by 1.4% on the S&P, hanging in here. Even as we get closer and closer to the cash open, we've got the Nasdaq down by close to 3%, negative by 2.9% so far this morning.
Yeah, how much is this coming because of what we saw in the casino that is the South Korean stock market for the Kospi? How much is this coming because there truly is anxiety about people's ability to pay for some of these really ambitious goals? How much is this partly because we have seen a tightening of the financial conditions? And to Neil Dutta's point, the fact that we are anticipating rate hikes starting to crimp some of the expected returns in equities. So how much of these things kind of came together?
Some better news in the bond market, if you will. Small glimpse of hope, maybe. Got a rally and offset, at least, in fixed income. Yields are lower by 3 basis points on twos to 419.83. Some better news also in the oil market. We're moving barrels. Forget the chit-chat. Forget the politics. All this market cares about in the short term is that energy's moving through the strait, and that's what you're getting. We're down by 0.75% on Brent, 77. WTI at 73. And really, really close to wiping out the post-war rally on the price of crude.
Yeah, and you nailed it. What are people doing instead of what are they saying? Not only is the Strait of Hormuz starting to reopen and some of those vessels that were stuck are getting out, but this administration is allowing Iranian crude to hit the market legally with those waivers we saw from the Treasury Department yesterday, at least while they negotiate the nuclear portfolio. So until the end of August, you can see Iranian crude showing up almost anywhere. Now, do we think that's actually going to happen? No, but I mean, it would be almost legal for a refiner in the United States to take an Iranian cargo.
Energy's moving for markets. That's good news. What it took to get the energy to move, we'll spend some time on that in just a moment. 1 hour away from the cash open. Let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. SpaceX is trying to stage a comeback this morning, trimming its losses, now down just 1% after it turned positive just earlier in the pre-market. But this is after yesterday's sharp sell-off that wiped out nearly $400 billion of market value off the stock. The positive sentiment coming as we're learning more about the company's first ever investment grade bond offering. It is looking to borrow across maturities ranging from 5 to 30 years because, you know, rockets are expensive. Turning to the rest of the tech sell-off, we are continuing to see selling in Micron, AMD, and the NeoCloud CoreWeave, and it's mirroring what happened in South Korea with memory leading the declines, with the cost being down nearly 10%, particularly because of SK Hynix. There was this report that came out that it may slow expansion of its AI memory business, shifting its focus to traditional DRAM chips, and that caused that sparked concerns about demand, just as Micron is set to report earnings tomorrow. And we end on AMC. The company had some positive news out yesterday that it had its busiest weekend so far this year, but shares are plunging 23% after it announced plans to raise roughly $200 million through a stock sale. The cash will help to pay down AMC's debt and help its balance sheet. Still, it is a diluting event that even Woody and Buzz Lightyear cannot save. John.
Yara, thank you. Appreciate it. The name is down by more than 20% this morning on SpaceX. Robert Schiffman of Bloomberg Intelligence with a classic dad joke this morning. How do you organize a space party? You plan it.
I love it. Thank you.
I
know. You think it's terrible. I welcome the
You were reading this at the same time as me,
weren't you? I think it's great. Yeah, but I went straight to a point that he was making, which I thought was really interesting.
You got to the actual substance.
Yeah. But I appreciate a good dad joke. Don't get me wrong. But talking about how this actually could be the template for what we can expect from Anthropic and OpenAI. The idea of coming out, getting a cushion of liquidity underneath you from the equity offering, and then quickly raising as much money as you can in the debt markets before people lose faith. Because ultimately, it is a race, and they need to win.
Yeah, it's not the space race, it's the race for capital.
Correct.
Ed Ludlow's talked about it repeatedly. Any opportunity you've got anywhere, any currency, any asset class, they're taking that opportunity right now. Let's talk about a different asset class. Let's talk about crude. The president announcing funds from lifted Iranian sanctions will be put in escrow to be used exclusively to buy U.S. goods.
If the sanctions go out, money's going to be put into this country. All that money's coming back in the form of purchases of food, which they desperately need.
Can you ensure that the Iranians won't use profits from oil sales to rebuild their military?
Well, they're not supposed to be doing that, so we'll see. But they're supposed to use money to buy food for their people.
Iran now has 60 days to sell oil on the international market. Crude this morning, 77 on Brent, 73 on WTI. Joining us now to discuss, the former White House senior advisor and partner at TWG Group, Amos Hochstein. Amos, we'll start broadly and we can get into details. What's your reaction been to how this has played out over the last week?
Well, quite remarkable because the MOU in itself is little more than really, I mean, it's almost like a surrender. I mean, if you think about where we started a few months ago and what policy has been for the last several decades and where we are today, we have basically said for 60 days we are removing massive amounts of sanctions off oil, gas, and petrochemicals and refined products. You can sell it anywhere in dollars. We haven't done that in many, many years. They can also get some access to their own unfrozen assets, $6 to $12 billion, depending on which report you hear. They get other benefits, and all they had to do was to open the straits and agree to talk. So we haven't actually agreed to anything on the nuclear, but we have agreed that ballistic missile program and support for proxy terrorist groups in the region are not on the table and not part of the negotiations. And we've given them the huge political win of now being the decision makers in Lebanon, which is quite astonishing. So this is what we've done. We've given them this whole document is incentives and agreements to give Iran things with the hope that we'll get something out of it some point during the 60 days. And the clip that you showed a little bit earlier with the president talking about buying food and medicine, I think he's confusing two different types of revenues. The food and medicine is really, I think, what they're trying to do with the unfrozen assets in Qatar, the $6 to $12 billion. The oil revenues, they can sell and do with that revenue whatever they want.
When it comes to that oil revenue, Amos, where do you think the Iranian crude will be going? Is this just legitimize the Chinese buyers, or will they actually find new customers?
I assume that at first it will just be the Chinese customers with legitimacy and probably Indian consumers as well. And then the rest of the market will wait and see, and to see how long this lasts, because the worst thing is you unsanction something, the Americans and the Iranians get into some tiff, a week from now, 3 weeks from now, 5 weeks from now, and suddenly what you bought that was unsanctioned is suddenly sanctioned again. So I think people will take some time to figure that out, except, of course, some trading houses that will buy a whole bunch of Iranian crude and blend it, and then they'll be able to sell wherever they want. So I think you're going to see sort of a broadening, but it'll be a gradual broadening.
I know they're not a monolith, but do you have an understanding of where the GCC is on this, given the fact that it is pretty remarkable, as you said, to see this U-turn from this administration to allow Iranian oil to legally hit the market? Well, we haven't seen this in 4 decades.
Yeah, this is, again, I think that you're right. The Gulf is not a monolith. Clearly, the political winner in the Gulf is Qatar, where they are setting, to some degree, setting American policy. They're in charge of American Middle East policy right now in quite an extraordinary way. They are quite gifted at this. And I think that there are others in the Gulf who are looking at this and saying, wait a minute, we don't really like Qatar foreign policy, and now it's running American foreign policy. Iran was a threat to us. The United States convinced us to join them in conflict. Now they're emerging stronger politically at home, right? I mean, you can't imagine anybody going out and demonstrating against the regime right now. Help is definitely not on the way. And so they're left with a neighbor next door that is angry and vengeful and is going to be very well funded. And if they are very well funded, if you talk about their sales on oil sales alone and petrochemicals, you're probably talking about revenues of about $1 billion a week. So those countries in the Gulf are looking at this with great concern, and they're going to have to invest in their own defense in the long term, thinking that the United States has become extremely short-term thinking. That's kind of how they view us at the moment.
Amos, we're looking at oil prices because that's what the market is looking at. And they're somewhat agnostic, as John has mentioned many times, about exactly how oil is getting from one place to another and the potential geopolitical implications, at least in the short term, saying, look, at least barrels of oil are going through the Strait of Hormuz. Do you think that this is an accurate reflection of the potential risk of an additional closure? Because if there is true control by Iran over the Strait of Hormuz, should there be a higher premium to potentially offset against the risk of something like this happening again?
Look, I think if we were talking about this 5 years ago, 10 years ago, yes, you would talk about risk premiums and so on. But the market at the moment is basically saying, I have a lot of news that I want to look at on the tech side, how much CapEx is coming in on AI and data centers and blockbuster IPOs and space. That's what I want to focus on. So energy really is judge us. Is this something that's going to drag me down or not? If it's not going to drag me down, I don't want to talk about it. Everything is fine. I don't want to hear people telling me about risk premiums. And so that's where we are reality-wise in the market. Do we have a risk in the market? Of course, because the one thing that's come out of this conflict is Iran, as I said on your show a few weeks ago, before this agreement, no matter how this war ends, no matter what agreement we reach, Iran sees it as they control the straits. And control of the straits does not necessarily mean a toll. It could just as well mean I decide that tankers need to give me 48 hours notice. I can decide that I don't like a certain company. Your tankers are not going through. Those kinds of things. So yes, there's a risk, but I don't think the market is there to look at it. The second piece of that is, while oil prices are coming down, they're still at, Brent's still at 77, WTI at 73. In December of this past year, December, January, before the winds of war started blowing, we were at $56 to $60. So we're still trading at a significant premium to where we were before the winds of war in December. So I think if the prices start coming down further, which I think they will, at some point you'll start saying, okay, can they really go back to where they were in December? And that's where we'll see probably a $5, $10 risk premium that will be put into the market.
Even Amos managed to get the tech trade in there. You notice that?
Well, I think
Right.
that there's a bit of frustration, at least when people look at the geopolitics, saying this actually matters tremendously, but they can't get anyone to care because everyone's saying, ooh, space.
Amos, I'd love a final word with you on that. There was some discussion that the rebuild effort would be so costly, so expensive for nations across the Gulf that they'd be distracted from spending all this money on tech, on AI, when there has been some excitement, particularly over the last year, about sovereign AI and the amount of investment that would come from that particular part of the world. What should we be tracking now? Where's the money going? Where isn't it going?
So I never agreed with that notion. I think countries like UAE and Saudi and others are really looking at tech as a long-term diversification away from oil in their national economy and budgets. That has become more acute, not less. They're going to be spending money, one, on diversification of their energy sector away from the Strait of Hormuz, so building out infrastructure, which sounds expensive but really isn't. It's a few $1 billion here and there to build out this infrastructure. And the second piece is to double down on their investments in tech, and most of that is going to be in the United States, because where else are you going to invest? There's a ceiling for them in how much they can invest in China. They're continuing to invest there, but there's a ceiling. Europe is non-existent, or there's a little bit of play here and there, but it's really small amounts of dollars. And so the bulk of it will have to come to the United States. And I got to say, I've been to UAE and Saudi. The build-out that's happening there is going to continue to expand. The question will be not how much they want to spend, but will companies, American companies, European companies, want to build data centers in the Gulf, or will they be more hesitant as a result of this? But I think you're going to see more money coming in to invest in this sector, and I think it's going to be mostly in the tech sector, some of it in healthcare and other in sports and other entertainment sectors around the world, but mostly, again, I think in the United States.
And not in golf, apparently, for now. Amos, it's good to see you. Thank you, sir. Amos Hochstein, the former White House senior advisor. Looking at equities as we have this conversation, making new session lows. We're down by close to 1.5% on the S&P, down by close to 3% on the Nasdaq 100. With an update on stories worldwide with your Bloomberg brief, here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. President Trump is signing 2 executive orders to fast-track the development of quantum computing, including the development of a quantum computer for scientific research by 2028. The move is seen as a national priority and is expected to lift stocks in the quantum sector. Qualcomm is in advanced talks to acquire AI chip startup Modular in a transaction valuing the company about $4 billion. Qualcomm is trying to pad out its product line to better compete with market leader Nvidia. A transaction could be announced in the coming weeks. And in sports, Lionel Messi is now the all-time leading goal scorer in World Cup history. After missing a penalty shot against Austria, Messi scored twice to power Argentina to a 2-0 victory. He now has 5 goals in 2 games so far in the tournament and 18 all-time in his World Cup career. And that is your Bloomberg brief. John.
Vonnie, thank you. Over to you, Cristiano Ronaldo. Portugal playing Uzbekistan a little bit later this afternoon. England playing too.
Yeah, look, I think nobody wants to be put up against Lionel Messi because he's also so likable. I mean, honestly, he is such a likable character, and he's almost 39, and he's playing at that level.
It's pretty incredible, isn't it?
It is absolutely unbelievable, and absolutely the leader of his team. It is really fun to watch.
Truly phenomenal. Amazing. Up next on the programme, we'll set you up for the day ahead. Plus, Brent Schutte of Northwestern Mutual on the changing nature of AI investment. A conversation up next with equities near session lows.
This is a kind of a normal thing with a market that has been up so much this year. However, it's kind of the opposite of a bubble. What we're seeing on both the S&P and, as I mentioned, the information tech sectors is that those multiples are lower today than where we were coming into the year. It's been all driven by earnings.
The earnings have been fantastic. We've heard that point repeatedly. We heard it again this morning from Phil Camporelli of JPMorgan Wealth Management. but we've had a massive move in this market, and now we're taking some back. We're down by 1.4% on the S&P. On the NASDAQ, we're down by close to 3%. The opening bell about 41 minutes away. Going into that cash open, just a note of a few things you need to look for through today and through the week. At 9:45 Eastern Time, PMI data. Look out for a read on the US economy. Later on, we'll hear from the president. Worth looking out for any headlines you might get around this deal with Iran and the amount of energy that's moving through the Strait. Then also later, we'll get earnings from FedEx, so look out for that too. And then at 7 p.m., we'll hear from the US Treasury Secretary. He's speaking at the Economic Club of New York. Always worth a listen to Scott Bessent. That takes place later. Tomorrow, probably the main event on the earnings side. Really is the main event on the earnings side. Micron after the bell tomorrow. Massive run up in that name. Given the moves we've seen today, a lot of weight on the shoulders of that stock.
Yeah, how high are expectations? How high is the bar for this name, given 880% gains over the past 12 months? And how much can they lean into the idea that they are producing that much more of the most expensive AI tools, some of the biggest memory chips that go into these large language models and the data centers, to rebut what we've heard over at SK Hynix?
So let's get to the sell-off. You see it in South Korea, spills over into Europe, into the US. Equity futures down across the board on the S&P. On the NASDAQ, we're down by close to 3%. The global tech sell-off gaining some steam going into the opening bow. Brent Schutte of Northwestern Mutual writing the following: we believe the nature of AI investment is changing. While capital markets remain open and funding is still available, that dynamic could change if financial conditions tighten further. Brent joins us now for more. Brent, welcome to the program. Obviously, we've had a big run-up, and this is a small move lower in the context of that massive run-up. But do you see signs right now that this could be the start of something bigger?
I think you hit the nail on the head with my opening comments, so thank you. This is where I think AI has moved from being funded out of cash flow, which I think everyone knows, to now being subject to lots of debt, lots of equity, just given the expensiveness to bring it to life. And that changes the ballgame a bit, and that makes it more economically sensitive, which comes at a period of time when the Federal Reserve is contemplating raising interest rates, which could pull capital markets back or make them less friendly. And that's where I think the narrative has changed a bit. I hear the comment quite a bit in the opening about earnings and this being different this time. I think people have to think about the sustainability of those earnings. Think about a company that you just mentioned that's more of a commodity type of a product they produce. I've heard the word insatiable demand, but capitalism has a way of satiating demand. And that's where I think you're seeing improvements in technology. And this is where I think the question is, what is the sustainability? And it's not just all earnings based. There are companies out there, plenty of them, that are trading based upon the what ifs of the future. You've seen non-profitable tech companies move up, and that's just where I think there's quite a bit more risk in the market today than there were 6, 9, 12 months ago.
Brent, there's a lot to pick apart there. How much do you think what we're seeing right now is truly a realization in equities that the Fed could raise rates?
I think a bit, although the market's not pricing in the reality that they're going to need to raise rates probably more than 25 basis points. So I think that's the question. And there remains an open question about whether a Warsh-led Fed would actually, cut rates or raise rates enough to actually pull the economy back. I think the reality that investors are opening their eyes to is that over the past couple of years, the Fed has cut rates. They've done so because the labor market has been weak. And they've done so even though the other side of their mandate was failing also, which now that the labor market appears to be healing, the question, I think, is do they actually raise rates because that mandate hasn't been met? And that's where I think the bar is really low still for investors to kind of realize they may have to cut or raise rates by more than 25 basis points, which could bring that economic cycle into a bit more jeopardy in the future.
So, Brent, this is important because we caught up with Kate Moore of Citi earlier on this morning, and she said the inflation pressure would actually put pressure on investors to deploy capital into any pullbacks in the equity market. Are you countering that with concern about inflation leading to higher rates?
This is where, look, the reality is that the consumer, which is a large part of the U.S. economy, has slowed quite a bit over the past couple of quarters, and the economy's been held up right now by AI. You've seen information processing equipment and intellectual property products drive GDP, all of it, for the last 2 quarters. And that's where I think the big question is, what do higher rates do to the consumer? What does higher inflation do to the consumer? And that's where you've seen that consumer slow quite a bit. Because of the reality that real wages have been negative. Throw in the reality that a lot of spending has been done from stock market gains. And that's where you have this circular risk, kind of like similar to the circular risk that you have in some of those financing deals that are happening in tech. And that's where, the economy is somewhat beholden right now to what happens in equity markets, just given the fact that the markets are so much bigger than the economy and people are spending out of their equity gains. And that's where they've been funding those from.
True. For many people, at least. Brent, thank you, sir. Appreciate it. Brent Schutte there of Northwestern Mutual on this equity market. As we're having this conversation, reflecting on an upgrade, a price target upgrade coming from the team over at Barclays. Vinu Krishna and the team did this back in March, of course, in the depths of the war. It was the right call. We had a massive rally off the low around that time. They've upgraded their price target again on the S&P 500 to 7,800 from 7,650. But if you read through the note, the quotes I'm seeing from Barclays are not overwhelmingly bullish. They're acknowledging some of the risk out there. For this to gain steam, to get a bigger move in this equity market, you're depending on other things.
Yeah, this is a show me the money moment, and that's really what we're going to see from Micron tomorrow. Barclays coming out and saying the equity bull case remains intact, but earnings and AI capex visibility must do more of the work as Fed support fades and positioning is less able to absorb disappointment. That's certainly what we're seeing today with respect to even a disappointing report out of a local media outlet in South Korea potentially triggering what we're seeing in terms of skepticism.
And to your point, Jonathan, this doesn't feel overwhelmingly bullish. He's talking about the macro backdrop of U.S. equities is complex. It's not off to the races. A lot of things need to go right. And also it makes it a little bit harder given the Federal Reserve and the fact that the market has hikes now baked in.
I give Vinu so much pressure, so much credit, you know. Under massive pressure in March, everyone was talking about how earnings were great, like in April. But in March, the team over at Barclays were like, look, forget the Iran thing. I don't think it's that important. I know that became fashionable in the weeks after that, but they were very early with regards to this rally we saw off the low in the equity market.
One of the key edges was they understood stockpiles, and they understood how long it would take for those stockpiles and the floating oil.
It was a cushion.
It was a cushion, and at that point, that was why they could get bullish. The idea that you have to show me the money, though. Again, how high is that bar given some of the skepticism?
And he was one of the first people to say these stocks will do well, maybe because of what is going on in Iran. But I remember when he made that call that my eyes were almost popping out of my head because you have a serious kinetic war.
I think he almost threw something at him. I remember the conversation.
Yeah, and he said if he was wrong, he'd come back on. But, you know, he was right. Good for you.
He can come back on. Are you feeling better about things now? A little bit more settled? You sorted out your differences over baseball?
Oh, well, I mean, you didn't have to, like, trigger me to start the show.
It was a Dan Ives quote.
I think
he might be coming on tomorrow.
I'm pleased we addressed that. OK. Coming up tomorrow, Tom Becker of BlackRock, Dan Stuyven of Goldman Sachs, Libby Cantrell of PIMCO, Francis Dollard of RBC. From New York City, for our audience worldwide, thank you for choosing Bloomberg TV.